4th of July savings are at the Home Depot. It's game time, so trim it like Trey, set it like Seth, and sear it like Celine. Make every guy...
Wow. That was Mike West. $199. Jeez. Well, you're up to $2. Still 6 now. Anyhow, 207. Should I call it a winner? Damn. $229. Woo! Okay. This train's got to stop. This train has to stop. Well, we broke the 200 SMA. It was a double top resistance, as some would say. Well, we broke the 200 SMA. I didn't think we'd go up this high. I had a lot of contracts. This could be one of the biggest trades I've made all year. Take some profit, Jimmy. Well, my finger picking full, we're at 237. I'm a finger picking full, I'm going to heaven. I've died and gone to heaven. I've died and gone to heaven. I'll take another sip of coffee. I can't believe I'm still holding these things. You still in the QQQ? Hell yeah. 85 cents. Whoa. SPX are at 85 and the QQQ are at 218. Jim, you just broke a few walls. Did you see the 9 EMA cross the 21? Whoa. 229. Well, I bought this little guitar back in 1991 at Bluegrass Festival in Winfield, Kansas. Well, I don't know. I've held these so long now, I think I just hold them longer. And very seldom do I trade the QQQ. It's a Head and Shoulders right there on the SPX. Okay. I think I will run down and get a sandwich or something. Yeah, I think that's what I'll do. It's going to be a long day. Slash ES is at the VWAP. If that breaks, we'll go higher. If not, I'd scale or just see if we're getting ready. We're squeezing. We're set up for a squeeze again. These market sell-offs have been happening every single day. There's 234. Let's go. Okay, well, I'll be right back. The 75/40s are looking green, and I'm at 281. These things are going to take off. We just now broke the VWAP. The market, the way I feel it is now, it's not like I'm scalping every single trade. But if you wait for the setup, you'll get your trade every day. I was faked out a couple times on this one. Couple good times. We're almost at $3. Shit. 75 to $3. Woo! Okay, well, I'll be back. I'm gonna go get lunch. Scale out some of these.
Be something to look at right now.
Okay.
Yeah, that post-earnings sell-off, and if you look at their AI semiconductor revenues, $56 billion they anticipate in 2026, and $100 billion in 2027. That sounds good, right? But at the same time, the street was anticipating a bigger growth rate, and the whisper numbers were above those levels. And then you also saw that the company gave decent guidance, but then their gross margins are supposed to, in the current quarter, supposed to dip. Remember, they were above 77%, supposed to dip into the 74% level, and that's why the stock has been hit. It's now 25% off of those all-time highs that we hit just going into that earnings report. You mentioned the fact that they re-upped or expanded their partnership with Apple. They get 20% of the revenue from Apple, and most of the revenue from about 6 of the big tech companies at this point, so they need some diversification. And also remember, we always talk about this capacity constraints that a lot of these chip makers have. Well, they're in the specialty chip making space, but they still rely on TSM and some others to build their chips, and they just can't get enough out the door at this point. And Hock Tan, during the last the last earnings call, he wasn't as rosy as maybe the street anticipated, but that's what happens when you go into an earnings report with the stock sitting at all-time highs and the bar's really high, and they don't deliver what the street wanted at that point.
I remember that. There was some feedback about that earnings call. All right, let's get into the example trades. Kevin, let's start out with yours. What's your approach today?
Yeah, this is a tricky one because this deck is really been
312
moving today. And so I looked at the expected move out to the end of this week, around $16, Diane and Tom. And I looked at something, if you think that it hit that 200-day moving average, you may want to look at something in the bullish camp. I looked at about a little more, a 3-week
$3.12
in Broadcom. So giving yourself a little bit of duration here. Why? Well, their earnings are September 3rd. So this goes out to the end of July. You've still got plenty of time there. So I bought the 165 call. Now the stock was closer to 165 when I did that. Sold the 180. So a $15 wide call diagonal. We started out pricing it around $16. We moved it up to 17. Now it's 18 and a half, Tom and Diane. So this stock has really recovered today and is moving higher. Yes, can you do a 170, maybe 185 call diagonal? Probably can. Remember, the key is look at the expected move for this week, about $16. That's why I made my call diagonal about $15 wide. Yes, you can lower that net debit by moving the long option closer to expiration. Mine's 3 weeks out, just a little bit different because I wanted to give myself duration for this to work and chip away over the...
Can't we just get along? Mess with my food, your ass will be grass. My God, look at that. Woo! $345? Are you kidding me? On the QQQs? They're now at $3.55. Randy? Nobody calls them like I do. You missed this run. Oh shit. Randy. Oh gosh. I sit here all day. You go get baked. I think you should ship me some. I'll take an eighth of an ounce. Randy's probably got a big old war chest full of different kinds of weeds. Well. I'll be going and getting me a sandwich. This is an incredible run. Okay, time for sandwich. Now I'll be right back. I gotta get something to eat. Oh, my little baby's
Higher
up.
at the moment, but it's been a difficult year for Microsoft and its share performance. It's really been
Because of Bill Gates sucks.
What does your latest data look like when it comes to
Poisoned his
consumer
wife.
trends?
Hey, I'm gonna tell you something, you fat cats. We know you don't have any moral compass. Let me tell you something about Bill Gates. He poisoned his wife. He's a piece of shit.
Across the board, whenever you're considering, it's Office products, it's cloud products, it's AI products, Xbox. So a lot of different subsidiaries in here that we're tracking on this line. But you can see on the end of that chart, that blue line is consumer demand, the dotted line is the stock. And so when we see divergence like that, we see a sign that perhaps we're still sitting a bit oversold right now for Microsoft. And I think what's really promising is when we look at what's driving this, the two big factors in our data that are driving this bump up are adoption of Copilot and overall Microsoft's AI products, and also continuation of that momentum that Azure has built. Last quarter, I think Microsoft's cloud business was up about 40% year over year, and we see, at least in our data, this momentum in cloud continuing. So for us, this is a bit of a bullish divergence opportunity when we look at Microsoft, because we see the consumer saying one thing while the Wall Street appears a little bit spooked by CapEx fears and perhaps a little bit of a gaming mess right now going on in Microsoft.
Megan, it's a fascinating study, the way we look at their role in AI, because, let's face it, the way the market is trading right now, memory has gone crazy on the upside and software has been punished. But that's creating a pretty interesting valuation for both of these. And it certainly looks like, with everything as diverse as Microsoft is and its products, software's come under pressure, and now the winners in software look incredibly inexpensive versus the others. In your data, your consumer demand, that shows basically no drop off in demand, but an extreme drop off in the price of the stock. It shows one of those rare circumstances where Likefolio's data really points out that we don't know why the stock has gone down. It went down with the software piece. It went down because they loved memory and hated software. But certainly there's been no real drop-off in overall demand for their products. Am I seeing that right?
Yeah, that's what we're picking up on. I think that some of the software fears for some companies was definitely warranted, but maybe this is not the case for Microsoft. Microsoft is so embedded in enterprises. It's so embedded in the way that employees use its products. Even if you're using AI, it doesn't mean you're not using one of Microsoft's products. And in fact, I think it's actually making Microsoft's products a bit stickier in the way that these tools can work alongside the products, in the way that consumers and users can improve their workflows with AI, with this software. So I think that this is one of those rare divergence cases, as you mentioned, where perhaps this is the fear has grown too high, the stock has been too discounted, but certainly an opportunity for investors with a bullish thesis for Microsoft is certainly we have, where we have this Main Street score, so this consumer score, potentially probably one of the highest in our universe. If you were to just plot the score here, we have our Likefolio score for Microsoft at 92, which is extremely high, but that investor sentiment score is down around 25. So that's a pretty significant gap. And we think that this is a pretty compelling setup, especially with earnings at the end of the month, where we see a lot of stickiness right now in Microsoft services, and we see continued growth. When we look at Copilot, I think that the seats added grew by about 250% year over year. And we have that rate continuing. We have that rate tripling right now in our data. So continued momentum on the AI adoption front, and also just over its overall products. I think the weakest spot we see right now is in its gaming services. And I think that that's pretty understood, that's well known, and that's not really the driver right now. The key right now is AI adoption and cloud, and can its services remain sticky? And so far, it seems like they are, at least in our data and what consumers are talking about and the demand trends that we're noting.
Megan, there's literally minutes ago some news from Bloomberg about Microsoft and efforts to reduce AI costs, starting to replace OpenAI and Anthropic with their own models in software products, the ones that we know, like Excel, for instance. And again, this is Bloomberg reporting here. I wonder if that's an attempt, not just to reduce AI costs, but all the concerns about, for instance, OpenAI and even Anthropic. If you think that, and I know this is this is very fresh, so you don't have it integrated in your data. Do you think that helps the case for Microsoft? Or do you think that's operating from a position of weakness with that move that they're making?
I think that certainly helps the case with Microsoft, especially since, cost control and margins were a big factor in a lot of this rising investor fear. So if Microsoft can cut some costs there and continue performing and executing, and certainly obviously the company thinks that it will, if that's true, then I think that certainly helps Microsoft's case long term. I think another thing we haven't talked about is Microsoft's approach to, make its AI models even stickier within companies and within its customers. I think earlier this month it launched Microsoft Frontier Company to embed its own engineers to help its clients, build out their AI use cases. And I can't think of anything stickier, versus just building a tool and passing it along than, actually embedding engineers inside these companies to help them leverage AI in the best possible way. So it seems like Microsoft is starting to pull the levers to flex its AI strength. And it almost reminds me of a Google whenever, we used to talk about how AI was going to kill Google, and it certainly didn't. It seems like Microsoft is the next example here where people were really concerned that it was going to kill its software component, and we just don't see that, at least in our demand data.
Megan, trading big companies like this, a lot of times they get drawn into whatever the bad news is that's out there. And now this news that Tom White and Diane reported on the air right now about them moving things more in-house and away from Anthropic and OpenAI. I'm trying to figure out if that's good news or bad news, frankly, because these circular partnerships that they have, now it's probably good for Microsoft, although I'm watching the 1-minute charts and Microsoft is just starting to rally off this news now. Originally, it really didn't move. The 1-minute charts have it starting to move up, so I assume that this is going to be overall good news that they're bringing it into in-house chips. But what about all the partnerships that these companies have?
Yeah, I mean, that's very valid. We'll have to see how things shake out. This is obviously very fresh, but I think that Microsoft right now and has proven that it's a leader in these arenas, whether it's software, whether it's AI, whether it's becoming sticky in enterprise. So we have to assume that it's, thinking strategically about these decisions. And for us, I think that a lot of fear is already still discounted and built into this stock. And so certainly long-term, our outlook on Microsoft is growing more bullish, and even near-term, especially as we get closer to this earnings event, it'll be very interesting to see. I think if Microsoft can come out with a really strong quarter, and we think that it will, it could help kind of calm some of those fears. So interesting setup building in the next couple of weeks, but our data certainly is trending more positively for this name.
All right, thank you, Megan. That's Megan Brantley, Vice President of Research, LikeFolio.com. Now, for the trading perspective of all things Microsoft, let's bring Tom back into the fold. Tom, you got the insights from the LikeFolio team. You flagged that Bloomberg report. Your thoughts before the example trade?
Well, yeah, we've seen that big, massive pullback in the shares since they hit all-time highs just a year ago. Remember that. But, Kevin mentioned this, and not sure why the stock has pulled back. Well, their cloud growth, Azure, is slowing a little bit. The investments that they made, what AI brings to them, they're most vulnerable for AI to maybe take over processes that they have. He talked about the SaaS apocalypse that we kind of went through, where software stocks were getting dragged down, and that dragged Microsoft down. But maybe moving away from OpenAI. Remember, they've got a 27% stake in OpenAI, but both companies have kind of pulled away from the governance part of it, where they can sign up for their own partnerships. I mean, the backlog that OpenAI has with Oracle is worth $300 billion if it ever comes to fruition. So maybe that's part of the reason. But Kevin mentioned valuations, forward PE on this one near the 20 times level. Historically, about a 5-year average is over 30 times forward PE ratio. So yeah, it's cheaper now than it's been in a while. But Kevin, you got an example trade for us here in Microsoft. Go ahead and walk us through it.
Yeah, Tom, they have earnings coming out on July 29th, so I stayed ahead of that and just looked at pricing the butterfly, the unbalanced butterfly, like we do. It didn't save you a lot of money. So sometimes when you go through these tests, what comes out is the more basic trade, which is just the vertical call spread. So I looked at the July 24th, staying ahead of the earnings event, bought the 395 call, measured the expected move out to there of about $25, Tom, and then I sold the 420 call. So the 395, 420 call vertical, it was trading about 790, trading almost 830 now as the stock has picked up a pace here a little bit. But Tom, this is one that just takes advantage. It'll be about if an $8 spread goes to $25, that's more than a triple in terms of return on this trade. So if you think there's a chance that Microsoft could bounce off some of these numbers and rally back up, this is a vertical call spread that, if right, remember, here's the thing about the vertical, you need to be right on the direction. The break even here is over $400. So you need to be right on the direction, Tom, but if you are, it's about a triple in terms of return on your money.
This one down July 24th, a weekly option series. So Kevin gave himself 17 days in this example trade, buying the 395 strike call basically at the money, and then selling the 420 call bullish $25 wide call vertical to the upside. You're paying roughly about a $790 debit, maybe a little bit more. The debit you pay is going to be around $790 per spread. But Kevin mentioned that this thing can expand to $25. You got $1,700 in potential profitability in this one. If this thing does expand, the stock goes back above the 420 level at this point. You pay that $790 debit, takes your break even to $402.90 to the upside on this one. That's only about $8 above the current share price. So on a percentage basis, on basically a $395 stock, you don't need a massive move to the upside. It's directionally, pretty straightforward here. And because you've got a couple weeks until expiration and you're buying a vertical like this, it gives you that flexibility. If you see this thing starting to move back to 405 or 410, and the price of this vertical is going to start to expand pretty rapidly, if it does go higher, that gives you that optionality to say, hey, maybe I want to close all or a portion of my position if you bought multiple verticals, where you can say, market's open, maybe I'll take some of these off or all of them off if I'm into profitability range on this one. But a good risk reward setup, and if you look at it, implied volatility level is pretty elevated at this point, but those out of the money calls, we've got traders reaching for those, so they've got a lot of option premium in them, which offset some of the costs on the bullish 395 call that you're buying in this vertical position. So pretty straightforward bullish call vertical here if you think Microsoft's going higher, Diane, for an example.
Thanks, guys. We've got the breakdown coming up. George Solis joins us. Take a look at Adobe after a bearish note out of B of A. The stock managed to just shake that off today, but is it a bear trap? Fast market. We'll be right back.
with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Hey, Pop.
Hey, Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, I had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall, live on the floor of the big board. Before we get to the breakdown, let me give you a check of where markets stand as we get closer to the bottom of the lunch hour on Wall Street. The S&P 500 is lower. We're off by 0.25%. Dow lower by just shy of 0.33%. We're off the lows of the session, though. NASDAQ 100 off by 1.33%. Russell 2000 lower by just shy of 0.5%. Meanwhile, Adobe shaking off a bearish call from Bank of America. The bank is reinstating coverage of the software name with an underperform rating. B of A says the stock may look cheap, but generative AI is creating longer-term challenges for the business. And that's been the rub for shares, with the stock down more than 30% year to date. Another headwind, leadership challenges as it hunts for a new CEO and CFO. Time now for the breakdown. For that, let's welcome in George Silla, senior markets correspondent, with a deep dive into Adobe. So it's shaking it off today. I will say I'm surprised by this, especially given the performance Adobe has had and how it's been generally viewed. How do you want to break this one down, George?
Well, I mean, this is a difficult one if you're an investor in the company, because if you look at the creative suite of software and digital media creation and creative publishing, Document Cloud, also digital marketing and advertising services. I mean, Adobe is a very comprehensive publishing campaign company, but unfortunately, the application software names have been a drag. But this actually started for Adobe quite a long time ago, Diane. So it's not necessarily something we saw as of the last year, and that might be the case for companies like Oracle or Microsoft in the software space, or even Salesforce and Workday. Adobe's been struggling based on some of the competition, which is taking market share away from them, and this has been going on for quite some time. I mean, if you look at what's happening now in terms of high-quality digital content that can be created using text prompts, it's pretty amazing. And you can use OpenAI, you can use Canva. Google's got Veil, which is another platform. Figma as well, which again is another area for creative publishing. Pixelmator, which was purchased by Apple. So I'm just throwing out a bunch of names that do very similar things with Adobe. And what that does is it breaks down your moat, and effectively the defensive moat that Adobe once had, and the pricing power and the per seat premiums they were charging may be going by the wayside. So they have to reevaluate how they're charging their customers. But also, when you look at the AI monetization for them as a company as a whole, the average recurring revenue increases that we've seen in the last year have only been about 2%, and that's quite low. So despite the fact that they still are growing their sales in the double digits, low double digits, and valuation multiples are extremely cheap at 9 times earnings versus, let's say, 27 times historical 5-year average. And now again, that's 9 times based on forward earnings. It may be still a value trap. So I think that's why Bank of America downgraded the stock to underperform with that $190 price target, which is another about $30 or so off the current price, roughly speaking, because they do see these lower cost alternatives potentially displacing Adobe's market share even further. And so right now, Adobe is really playing defense versus offense. And I think that's why the stock is still down. It's had a nice week or so alongside the other application software names, as we see a little bit of rotation out of hardware into software. But can't say if this is a true turnaround or if it's just sort of a dead cat bounce and a long-term downtrend.
And that's the question. We don't know right now. Obviously, the sea change is happening right now, but how long will this last? All right, yeah. George, we'll put a pin in it. That's George Sillis, our senior markets correspondent, with the breakdown on Adobe. So let's get Tom and Kevin back in here for example trade purposes. So Tom, it's Adobe's shaking off that bearish take today from Bank of America, and Bank of America is basically saying, don't get caught out there. Your thoughts as you jump into this example trade?
Yeah, I mean, it's just been a falling knife. Anybody that's tried to buy the dip in this stock over the last couple of years has been hurt, unfortunately, on this pullback. But it's bounced about 20% off of those 52-week lows that we hit just about 2 weeks ago. It's up 10.5% over the last 5 trading days. One of the things I, kind of hit on with this company is the CEO's leaving, and the CFO are leaving. Why are they leaving? Well, maybe their outlook isn't that good, right? Long-time executives in this company, and that's probably part of the reason that you've seen the pullback, because their growth rate wasn't bad last quarter. And George mentioned valuations are extremely low on a historical basis. That doesn't mean they can't go lower. So I looked at a strategy, and I looked at the technicals on this one because it's bounced, like I said, nearly 20% from those lows in just the last couple of weeks. Just above, just at the simple moving average, which is just below $234 on this stock. Maybe that acts as an area of resistance because it hasn't spent very long above that 50-day simple moving average much over the last couple of years. So I looked at something that's neutral to bearish, taking advantage of maybe the pop that you're seeing today, the pop that you're seeing over the last couple of weeks, where I'm going to go out to the July 31st weekly cycle, so about 3 weeks to expiration, sell the 235 strike call out of the money to the upside, and then buy the 245 strike call. So a short, neutral to bearish $10 wide call vertical. You're going to collect roughly a credit of about $3. It might be about $3.20 now because the stock has moved higher. But if you collect that $3 credit, that's what you can make, $300 per spread with $700 in risk. But it takes your break even up to $238. That's about $5 below, $4 or $5 above that 50-day simple moving average on this one. But you're taking advantage of the rally that we've seen recently. And this downgrade today, they put the price target at $190. So if you think this rally is going to get sold again, this strategy takes advantage of that. Kevin, your thoughts here on the passively neutral to bearish short call vertical?
Yeah, selling a high probability short call vertical. Remember the stock, if you look at the chart, it's had a nice run up near the 50-day moving average. So this is collecting $3, risking $7. It's high probability, it's collecting theta, and of course it's risk defined, Tom. So a short call vertical, just saying that this run, got it up to a level, and now it may be time to assume some short deltas here. Do we know where it's going? Of course we don't. But this one takes a short delta in a risk-defined manner, Tom.
That break-even 238 to the upside, that's where you want it to remain below. On that short 235 strike in this strategy that you're selling, it's got about a 61% probability of finishing out of the money, which isn't that elevated, right? It's still a better probability of success on this one, but that's why you're collecting $3 at least at minimum on this out of the money call vertical, Diane. So neutral to bearish, kind of going along with this example trade on what the analyst is saying here about Adobe.
Yeah, I mean, honestly, it makes sense in the context of how it has been trading, like you mentioned, not just this year, but for some time now. And then the question is, who are going to be the new leaders there? Who's going to be the new CEO? Who's going to be the new CFO? More questions than answers, even though their numbers have been pretty solid. But again, the threat's been real, obviously. All right, that's going to do it for us today on Fast Market. I'm Diane King-Hall alongside Tom White and Kevin Hinks. Download the Schwab Network app. It's available in the App Store, and tune in 24/7 on SchwabNetwork.com. Stick around. You've got Next Gen Investing with Jenny Horn and Alex Coffey coming up.
Jenny Horn. Jenny Horny.
Actionable data and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at SchwabNetwork.com.
So what is unique about Schwab Coaching is the community.
There's a lot of energy, like-minded people are learning with you.
You can just see and feel all the excitement around getting to learn a new topic.
Some of you want to get everything face to face with you and 400 or 500 closest friends. Some clients like to be in the privacy of their own home on an online workshop, but still having that live interaction with the coach.
As I'm talking, questions are coming in from that live audience, and they help me fill in those gaps as an educator.
People learn differently, but all those ways we actually teach it all come back to the point of making a difference and helping you make progress.
And so that means not just giving you theory, it means giving you the practical implementation using our platform.
So we want it to be fun, we want it to be informative, and most of all, we want you to walk away with a skill set and independently be successful in achieving your goals.
You do that for me?
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing.
As we start to retest the triple top resistance, we're going horizontal here. I'm thinking the next time up, boom. That's the QQQ. Okay. May, June. April, May, June. ATMS. Business. Personal, business. Oh gosh, I got some bills due. Oh, that's in the wrong one. There's that ATMS. Okay. Now what the hell? Okay. This one's due on the 8th. Right. R. That can go there. Now, time for a cookie. 360. What the frick just happened here? Oh, okay. Not bad. Wendy's makes the perfect chocolate chip cookie. Next time you're in Wendy's, grab one. QXO. QXO. Well, I've had it charted before. Well, we're at a head and shoulders right now on 20-day 1 hour on QXO. Definitely out of support. They lowered the price target from 32 to 28. It completed its acquisition of Top Build. So they got $28 price target.
Microsoft is closer in size now to Amazon than it is to Alphabet,
They keep pumping Microsoft.
to Apple, or to Nvidia, and for the longest time,
Wish they wouldn't do
Microsoft
that.
was like the biggest company. So it goes to show, like, this stuff moves around, but right now it seems to be a kind of the return of the mega caps. They're fighting their way back here, all in all, but they got a long ways to go to make new highs. I mean, Nvidia's what, 20+% off its highs, 15% off its highs.
PLTR
Microsoft,
new high.
I mean, we're talking hundreds of dollars a share. There's a long ways to go for some of these names.
Okay, so no better place to start off our show than we'll be focused on Nvidia here, which is up about 1.1%. To Alex's point, you just made it now down about 16.5% from its high, which was around $236.54 a share. That was made back in the beginning of May now. And so we've seen a pretty substantial, just slow downtrend in Nvidia. We got some news today, though, that could be not necessarily aiding any of the fears. I would say definitely worsening the fears, but there's two different ways to play it. So China's DeepSeek is reportedly developing its own AI chip, according to Reuters reports. Now, the project has reportedly been underway for about a year, but this is being designed for inference, not training. Now, why that matters? The AI market is increasingly shifting from training models to running them at scale. So as AI usage grows, inference becomes one of the largest long-term sources of compute demand. And these inference chips can be optimized for lower power consumption as well as lower operating costs than, say, training chips. So this does help reduce its dependency on NVIDIA, as it has historically relied on NVIDIA's chips to help train and run some of its various models. Now, building an internal chip would give DeepSeek greater control over costs, supply, product development really as a whole, but this does follow a broader industry trend. OpenAI actually recently unveiled its own custom inference chip with Broadcom. Broadcom had a huge pop to the upside as a result of that news. Anthropic has also explored some of these proprietary AI chips and the delivery of those chips, as well as Alphabet, Amazon, Microsoft, and Meta have all invested pretty substantially in custom silicon. So this DeepSeek effort is reportedly still in the early stage, but I think that the bigger risk here is this continuous trend of AI companies designing their own chips, and obviously NVIDIA has a massive chokehold on the overall market with GPUs specifically. But it does seem like right now there is going to be an increasing trend of adopting your own custom silicon, where NVIDIA could potentially lose portions of the inference market that are currently served by GPUs. But again, we're talking more of a long-term story. I don't necessarily see this DeepSeek report as a massive disruption, and look no further than price today.
Yeah, and it hit its 200-day moving average a couple times over the last 2 weeks, and it's acted as a pretty, really strong support level. So important that there's a line there that you can kind of draw and say that seems to be pretty relevant. But I'm going to make this really simple for NVIDIA. You go back 5 years, this company wasn't even generating $20 billion a year in revenue. It's 10x that. Well, you look at where the stock was trading 5 years ago, basically 10% of where it is now. The question you have to have if you're a long-term NVIDIA bull is that going to happen again? I think it gets increasingly difficult to make that case when the numbers have gotten as big as they have.
As big as they have. If they get bigger.
But, it's probably going to be difficult for it to be another
makes no sense
performer after having already done that over the last 5 years. So a really important name, of course, generates a ton of money, but the growth, I don't see the tremendous upside surprise to the growth story like what you had, over the last 5 years. I just don't see the way for that to happen.
No, I feel like if we were talking like the hyper-growth stories, they've rotated into memory. I mean, like Micron, SanDisk, Western Digital.
And that might even be, nearing its end.
I was going to say, it does seem like you're always tracing this momentum in this market for like the next greatest technology or the next greatest thing or whatever at least has a chokehold on the market at the current time, like memory currently does right now, but NVIDIA for quite some time, GPUs were that type of similar momentous event for the shares, but now only up about 6% this year. It's been a very different type of environment for NVIDIA, but at least shaking off this DeepSeek news relatively well on the session. Now our next name today is one we discuss a lot because there is very polarizing opinions, it seems, coming out of the woodwork on Adobe. But overwhelmingly so, the street is fairly cautious on this name, and for good reason. I mean, this is one of the early stage AI adopters that has since really struggled to impress the street on a lot of different fronts. But B of A did actually reinstate Adobe at underperform with a $190 price tag, down from the buy rating the firm previously had. Also does tie it with a street low. But while the firm does believe some professionals will remain focused on pixel level control and continue to utilize Adobe's tool, they do believe that AI will displace large parts of the core market over time. The analyst also did flag rising risk to the growth profile as generative AI lowers barriers to content creators and increases really competition from the lower cost and AI native alternatives. And so it's interesting that they mentioned the phrase of AI alternatives, because that is what drew me back to a note we got last week. Last Thursday, HSBC also did highlight this AI alternative, saying that they do not believe that we will see this shift. We see right now this being, or at least HSBC, their AI products being additive, not cannibalistic. And they were basically saying this is still a massive opportunity for them to grow. And so it's just interesting to see two completely opposite views of thinking. And they had, I believe it was like a $308 price target. So two different ways to play into Adobe. You have a $190 price target and a $308 from HSBC last week, which shows the polarizing opinions.
The difference between investing and saving is that when you save, you don't really take risk, and the idea is that that money's there. When you're investing, in exchange for risk, you have the potential for reward. The potential for reward in some of these stocks that have basically been cut in half or even more so because of AI is tremendous. But it's because the risk is real. I do not know, and I don't think anybody knows the answer at the moment, what these companies will look like in 5 years. It is very possible that Adobe is still a leader in creative design solutions software-wise. But even if it is, how much money is it making on those products relative to what it is now? It's really hard to model these things out. And so I look at this and I see risk, but that risk works in both directions. And so if that's something you're comfortable with, it can make a lot of sense. But that's different for everybody.
That is, and I think that that's a great takeaway here, the ways to play into like growth expectations and I mean just like forward expectations for Adobe. As I do think that a lot of these notes that highlight some pessimism in regards to the AI threat to their overall just competitive moat. I think a lot of this is more long term, but we will see it play out or we will not. And it'll be an exciting thing to definitely watch as some of these companies perhaps could flourish and obviously some could see the opposite effect. But our next name today here, Reddit. We've not looked at Reddit in quite some time, but got some more, I would say, optimistic price targets today from Wells. We got a 187 from 176, so a modest raise from the firm, but still does imply actually weakness from where we are currently trading. So we're up about 1.2% today to 203.3 a share. Now they keep an equal weight rating and noted that Reddit ad checks remained strong in second quarter, which they'll raises their revenue expectations by 5%, and they expect third quarter revenue guidance to be slightly ahead of consensus as well. Now they also did point out that user growth remains tepid, and so as a result they're trimming some of their second quarter US daily average user net adds to 100,000, slightly below the street's consensus. Now 65% of analysts do have a buy or buy equivalent rating currently on Reddit, so a bit higher than Adobe, which is 59%, or 33%, excuse me, have buys. Still, the bulk majority do say buy this name. The average price target, though, 230, does imply at least 12% upside from where we closed yesterday. But 187 does leave a little bit to the imagination because, again, this was a raise, but implies weakness from here.
Yeah, this is where, if you're just looking at this from an investment standpoint, nothing to do with trading, which is a completely different discussion. I was just talking about, I don't see the upside surprise to an NVIDIA necessarily to get like this tremendous growth, but if we just make the side-by-side comparison to Reddit, it's growing faster, even though it's decelerating. Reddit's expected to decelerate as well, but it decelerates to a faster pace, from a faster pace than Reddit. And from an earnings standpoint, if you use that as a valuation metrics on a forward basis, it's like half as expensive. Reddit trades at like 35, 36 times forward estimates, where NVIDIA is like 22 times estimates. And so then you ask yourself, like, which company seems to have, I guess, a more entrenched business model? I think NVIDIA probably to most would be the answer there. So when you're making these decisions as an individual stock investor, and again, we're talking trading, it's different. You look for short-term opportunities. Like, you have the whole universe of stocks. Like, Reddit just seems like risk when there's other choices that are cheaper and from a fundamental standpoint are better.
Yeah, and I'm so glad that you mentioned PE, because that was exactly what I was going to say with our next name, which is the most expensive on a forward basis of all of these stocks, and that is Shopify, which trades at a 64 times the forward earning multiple. So that is costly. Now, Shopify always has had one of these high multiples there to me in the space of like a CrowdStrike, where they've just carried this relatively high valuation on a forward basis since, we've really been talking about them, but at least seeing right now some analyst favorability clearly on this name, as BofA did reinstate their coverage in Shopify with a buy and a $150 price target. Clearly does imply at least an upside from here. But they do see Shopify's backend infrastructure like checkout and payments as increasingly central to AI native transactions. They also do believe that Shopify could be a core beneficiary of the shift towards AI-driven agentic commerce, rather than being more so dismantled by it. And so this name actually commands, I did not check NVIDIA, which might be close, but this actually has the highest percentage of analysts, at least of the last three we looked at, that do have a buy rating. 77% of the 48 analysts pulled by PackSet do say buy this stock. And also average price target right now is 150, so perfectly in line with BofA. Does imply about 23% upside from where we closed yesterday. And the high is 200, low is 110, so fairly strong conviction actually in the expensive. And I think it's also really interesting that you could not find, I know they're all like tech companies broadly speaking, but all four of these names, every single analyst note mentions the threat or the basically opportunity of AI, but they're all so different.
Well, and the funny thing is too is, how can we know? Like, this is a guess, and it always is, but it's like we don't actually know what AI is going to disrupt and how it's going to disrupt. And I'm sure if you went back to 1995 and you started watching the internet getting built, we had different ideas of what was going to work and what wasn't going to work at that point, and certainly at other times throughout history. So all we can do is react as the information comes in and try to look ahead with the best foresight that we can. What I can say about Shopify from a fundamental standpoint, it actually is improving. Its free cash flow has improved tremendously. Its adjusted EPS is growing at a pretty decent clip. So you look at this company, you say, hey, they might be slowly but surely building up that cash stockpile. Perhaps they start doing some more shareholder-friendly things, and those are ways that they can improve some of those forward valuation metrics. But yeah, it's an expensive stock, and if you're looking for exposure that has to be in sort of a software-oriented world, you can see why some of these names stand out. But the nice thing is, if you're a self-directed investor, you're not required to have any exposure to anything you don't want.
That is very true. And if you want to avoid AI altogether, I actually wish you luck, because it's pretty much impossible to do right now, but it is definitely a road to travel, and I'm sure there are many that are of that same thinking. But we'll leave it there for the top of our show today. Coming up next, it's time for Chartmaster, and Meta got an upgrade on stronger growth and margins, while Broadcom from the same firm got a valuation downgrade despite strong fundamentals and broad street support. So we'll dive into some recent trends to watch in both of those names, and of course some divergence in price performance today. Stick around, we'll be right back.
Doo-doo. Welcome to the 200 EMA.
Connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Intern, this place is incredible. It's where I get all your office supplies. Your golf balls, your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between. Think I'm gonna be sick. We have to buy that now. Schwab.
Invest your way with Schwab.
Whether you're a bull or bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time for the Chart Master, and today we are talking two names with very different calls from Ernst Group, which is basically highlighting some favorability for Meta Platforms and some further weakness we could see for Broadcom just based on its valuation. So joining us now to discuss the charts of both of those names is Rick Ducat, of course, our Chart Master. Now let's start off with Meta Platforms, which is making the more positive of the moves today, but actually it's not been that way for the last several weeks or months now, and on a year-to-date basis at least. So walk us through some of the trends you're watching in Meta as we do get earnings. I believe it's July 29th, so those will be here before we know it.
Yes, July 29th, and I think that despite today's upward push, we are still within the confines of this downward sloping trend line. First, we had a high point that began after the earnings event that we saw in January. From there, kind of connecting these subsequent high areas. We still haven't really breached through this trend line then. You could also argue, though, that we do have a upward sloping trend line beginning with our recent lows and connecting these 2 points here. We bottomed out near 540, which was a notable level here because it represented a small gap. It was also pretty close to our 52-week lows. We had one kind of rough day there. 520.26 is where we ultimately bottomed out. So when we also think about some other horizontal levels to look at, there was another gap here. That was where we found our recent low point here. 566 to 580 or so. So that would be another potential support zone to watch out for. To the upside, 628 is our relative highs. 643 is a double top type of area that we had after the gap downward. Finally, the gap would be filled near 663. And if we were to think about our moving averages that we follow here, we have our two shortest term EMAs of the ones that we follow on this chart setup here. Our 5-day weekly EMA in dark blue, our 21-day monthly EMA in teal. Those come in at 593 or so and 584 roughly respectively. Pretty close to our trend line as well. So if we were to get some kind of significant downward move below that trend line, that would probably represent a breach of those two moving averages as well. But for now, we remain fairly close to our 63-day EMA, our quarterly EMA in gold here, coming in at about 602. Meanwhile, if we were to break through our downward trend line and get more of an upside push that continues, our 251-day EMA in orange, 632, stands out as a possible upside area of potential resistance. RSI has been improving, but for now we seem to be fluctuating a little bit here. Our green trend line is still in play. We are still above our 50 midline. We have not yet made new relative highs, though, similar to price. So that would be perhaps the next step for the bulls to be on the lookout for, would be for that continuation of this bullish trend developing here with the RSI and price reaching new highs in tandem. So finally, when we consider here our volume profile study, we can think about how we have a node at this low level here that is probably the most significant of all, because it's our volume profile point of control, our thick red line here near about 606. So we have pretty heavy trading at relatively low levels. There's another pocket of activity here between about 660 or 560 to 570 or so. So that could be another potential foothold if we move lower. Things do start to pick up again up here, 635 to about 675 is the next most important area of trading concentration.
Okay, yeah, and again, making at least a modest move today, so hopefully it's trying to reset the recent downtrend we've been in a lot of these Mag 7 names, but Meta definitely feeling some of that pain in the last couple of weeks. That being said, though, Alex, as we do look at trading Meta here for example purposes, say looking to lean into a more bullish conviction, as of course this firm did highlight today.
Yeah, and looking for that to happen in a relatively short amount of time as this stock maybe builds up some momentum. So looking at buying at the slightly out of the money call debit spread. It's the 620, 640. $20 wide spread, looking to spend $5. This expires on July 17th in this example. Your break even in that case would be $6.25. The interesting part of this trade is you'll notice you risk $500, but you can make as much as $1,500. Whenever you see that, first thing that should come to mind is that maybe this is on the lower probability of success, and sure enough, it's $6.25 or higher to break even, and you have to get to $6.40 over the next couple weeks for this to get to max profit. So you need upside and need it to happen in a relatively short amount of time.
Okay, now shifting gears to, of course, Broadcom did see some positive price performance yesterday, high to, of course, OpenAI. Now seeing a bit of a reversal, although not substantially so. I know we're down about, 0.6%. So we're not, erasing gains on at least to the last two sessions. But walk us through the latest with this chart, because I will say, from looking at Broadcom here, there's some pretty big gaps when you zoom out and look at some of the big swings we've seen over the last year, 2 years.
Yes, our last earnings event was one such large swing here, created a gap from all the way from 473 to 427 that has not yet been filled, or really even the high point after the gap has not been tested. So a far cry from our highs that we hit near 495. The trend line that was established before this earnings event, this blue line here, has been breached. Now the prevailing theme, more of a falling wedge type shape here, with our two white lines demarcating the boundaries of our price activity, both pointing downward but converging toward each other. Typically, this type of behavior would be regarded as more of a bullish type of setup. Really, though, with all these patterns here, it's certainly not set in stone which way things are going to move. What you're looking for in any case is a breakout beyond either of these important boundary areas here. So in this case, where the bulls might be looking for would be for the trend line to be broken here, perhaps around 395 at this point, and then also our relative highs near 413 here and 427 here. We also have another longer term interesting area to keep track of here, 382, a high point after our gap down, another high point shortly before a gap, and then a bit of a muddled area here in this area here, but it was also our highs that we saw yesterday. So that was a level that stood out as well. Then if we were to think about the high point of this range area and a couple subsequent highs, then we had a breakout here. That gives us a low point to watch out for near 353. Finally, another gap here near about 334. So some horizontal areas.
AVGO.
Planning any kind of trading activity on Broadcom. So when we look at our moving averages in this case, we are quite close to our 5-day weekly EMA in dark blue. Our shortest term EMA, the one that's most responsive to change, but perhaps the least reliable. 371 is where this
hope and change.
Roughly. We then have a bit of a confluence here as well between our 21-day EMA and our 63-day EMA in teal and gold respectively, representing 1 month and 1 quarter. Those come in at about 389 or so. So our faster 21 day is moving below our slower 63 days. So the trend does seem to be degrading more and more solidifying toward the bearish side. If we were to move beyond our boundary line here, 251, our yearly EMA, at about 342 would be the next most important level to watch out for to the downside. Again, this would be the most significant of our moving average as it encompasses the longest time horizon here. It'd also be the slowest to react to any changes. So for now as well, RSI is below our 50 midline here. Very, very modest trend upward. Our downward sloping red trend line has been broken, but still in bearish territory here. So some signs overall that point to slow down here, or possibly even early warnings of trend reversal. Now when we think about our volume profile in this case, we are back within this small node here between 370 to about 385 or so. If we were to move lower, the heaviest node of all, 330 to 355, comes in here. It contains our point of control near about 345 as well. So those are the important volume concentrations that we see on this chart.
Okay, yeah, and again, this made a pretty huge move after its earnings, but now at least seeing a modest pullback on today's session. Appreciate it, 250 Cat, for all of that breakdown, though. Now, as we think through trading Broadcom here, for example, purposes, Alex, walk us through the thinking.
Yeah, it seemed to be at a pretty significant level of support around 360, testing that area a little bit earlier. And so if you think that could hold through the end of this week, I looked at selling a put vertical at that level. So aggressive, but also short term, leaning into this weakness here, Jenny, as these stocks have been under pressure. Looking to sell the 360, 355 expiring Friday. You can collect somewhere around 170. That would be about a 2-to-1 risk reward. So you'd risk 330 with a chance to make 170. When we talked about this, depending on where the stock's trading, things are moving around, that can fluctuate. But always looking at that relationship between max loss and max profit to reflect sort of a loose benchmark of your risk. So at 2-to-1, this is a little bit more aggressive for a credit spread here, and 358.30 in that case would be the break even.
Okay, I like that. I think a good explanation of, two different ways to play into. Two of our largest names really is, of course, both of these stocks. Meta and Broadcom are both worth well north of now $1 trillion as far as their market caps are concerned. But we'll leave it there for Chartmaster today. Coming up next, though, it's time to dive into all of the latest with SpaceX, of course, with its fast track to the NASDAQ 100, as well as a slew, at least 15 different firms giving some bullish praise on the name today.
Fortunes, earnings breakdowns, and hot takes that teach you about stocks and markets. Follow me on X at npetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Have you ever watched an interview and thought, I wish they had 5 more minutes, or I want to know how they discovered that hidden gem? That's exactly where Market Matters comes in. I'm Marley Caden, and our podcast is slowing things down. We're going beyond the earnings to get to the heart of the people and companies driving the global economy. If you want the full story,
No, I don't want it the full story.
Subscribe wherever you get your podcasts.
It's a bad idea.
The Schwab Network app and get live coverage wherever you are.
Hey, Bob. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable. Wait, had a stroke? Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim is my financial consultant. I programmed that 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Back to next gen investing. It's now time for FOMO, and we are talking, of course, SpaceX. Unfortunately, that FOMO feeling a bit more to the downside today, but a lot of bullish praise from the sell side to get into is, of course, it joined the NASDAQ 100 in a fast-tracked way. 15 days, Marley. Marley Caden, of course, joining us here in studio for all of the insights. There's about 100 analyst notes on this stock today. It's a little overwhelming, honestly.
There are a lot, but I tried to do them sort of in the spectrum to give you the broad look at what we're dealing with SpaceX.
We don't want the broad look.
Alex that he used earlier today when we were talking about SpaceX and said it's not the warmest welcome into the NASDAQ 100. I mean, as we're looking at SpaceX today, they are trading down on the session. We're down more than 5%.
Because the market's in a sell-off, you idiot.
5% for most of the day, just off of that opening price at 150.
Oh, God, I can't take it. Her and I ain't getting along good today at all. Ooh.
Called for launching compute into orbit at a rate of 100 gigawatts annually by year end of 2029. The firm says that this amount exceeds global in-service data center capacity today, and sufficient material inputs will not exist in 3.5 years, the analyst says. This is impossible, is what she's saying. Also says there is no credible financial model that can support the company's roughly $2 trillion valuation at the time of the report. The company currently trades at an EV/EBITDA multiple of 538.5 and remains unprofitable with negative earnings per share of $2.94 over the last 12 months. So a tale of two very different notes there, with the street high and the street low. One really buying in to a lot of what SpaceX is selling, and the other using terms like absurd and impossible.
Yeah, so Bloomberg has a total of 35 analysts now that cover this stock. There's one sell rating, and it's Morningstar, and we know that they do sort of cash flow analysis, so that would probably make sense. But their price target would give them a $62 price target. So that sort of brings up the low end. You mentioned Raymond James, that brings up the high end. The only other one that's below the current share price is the MoffettNathanson at 131. So look, I know this isn't the only variables, but if we take these analysts as understanding kind of different things that could happen, if you were just looking at that, median price target of these 35 is 225. The average price target is 236. You know, 33 of 35 of them have better than the current share price. I mean, this is a pretty bullish stock based off just that one variable, guys.
Well, yeah, the average is 35% higher than where we are right now.
I know, and I think it's also interesting because every single note I saw, and you mentioned the Starship launch, which right now I don't believe is coming anytime soon. I mean, I know they're still in the testing phase, but it seems like we are also so banking on a concept that could not be like fully deployed until 2031, I believe it was. And I mean, I have to check that, but it just seems so absurd to me to be basically, I guess we do this with everything, but valuing something on a prospect of something potentially happening so many years down the road.
I mean, I think that there's a separate side conversation here that is important to this conversation that isn't mentioned in the notes, surprisingly, but the fact that there could be a Tesla SpaceX tie-up. I mean, this is something that is constantly being discussed. Dan Ives has publicly come out and said he foresees it by the end of 27. The prediction markets pretty much agree with that sentiment. We don't really have another metric really to look at for this. There's been no official commentary about a tie-up, but Tesla's probably the only other company we can have a conversation about in this same way, where people made a lot of bets on the promise
There's a big
of
old candle
really
finally.
intelligent founder and CEO, and it just happens to be the exact same founder and CEO.
I just been kind of watching this thing consolidate. Now we got a head and shoulders off 63, the SPY. And listen to this chick talk smack. Blah, 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 blah. So I want to think right down here somewhere. Right off this triple bottom in this here squeeze. The 100 EMA 10-4 SPX. Oh yeah. La 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 la. Bounce right back up. Bounced off that shoulder line. Yeah.
Plus 10 days from now.
Yeah, and I gotta say, this is one that I'd say it's sort of like, be aware of your risk parameters, because we've seen this thing be volatile, but obviously not a whole lot of volatility amongst the sell-side opinions, because there's just a lot of enthusiasm tied to SpaceX that we will continue to discuss, I'm sure, for the next several months and years. But we will leave it there for FOMO, so appreciate it to Marley Caden, host for the Schwab Network, for all of that breakdown. Coming up next, though, the market does continue to push new highs, but can this rally continue into the second half of the year? We'll discuss the outlook for stocks, whether AI remains the biggest driver of returns, and where investors can find further opportunity when NextGen returns.
She's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need, all in one place. I can set up her college fund.
I've been learning about new trading strategies.
Schwab helps me generate retirement income.
All this Schwab is everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Welcome back to Next Gen Investing. Now, strong earnings, resilient economic data, and continued enthusiasm around AI have helped fuel the market's advance this year. But of course, where do we go from here? The million-dollar question.
Where do we go from here?
Welcome in Ted Thatcher, president of Bright Lake Wealth Management. Ted, thank you so much for joining us. Always have a great conversation with you, but you have floated something I wanted to start with, and that's the possibility of the S&P 500 reaching 8,000. So what gives you confidence in that possibility when so much attention does still remain focused on this handful of AI tech names? And I know there's a lot of criticism on that, but they have really propped up the market so far this year.
Yeah, you know, Jenny, when I look at the markets right now, and really the reason I think that 8,000 is realistic is because right now the markets are actually cheaper than they were at the beginning of 2026. If we look at how the analysts were looking at basically coming into the year for 2026 and 2027, effectively they expected in 2027 for the broad S&P 500 to produce about $350 a share of earnings, putting the S&P at about a 19.4 times multiple. That multiple is actually compressed so far this year. So now analyst expectations have gone up by $50, expecting $400 a share per share of S&P 500 for 2027 earnings. And that brings the valuation actually to 18.4%. And so fundamentally, that's why I see the second half of the year as constructive.
One of the things, too, that you've highlighted is this idea that the AI trade has been rewarding the suppliers over the spenders. And we flagged this and have been talking about it for weeks, that if you go back to the end of April, early May, which lined up kind of nicely with Microsoft, Alphabet, and Meta's latest CapEx kind of round that they announced, that correlation between the two groups really separated and they'd become inverse. And you see it even today with some of the hyperscalers bouncing back, and then you see some of the semi-stocks going down. The chart we have on the screen here is kind of the five big semi-stocks and then the five big hyperscalers on the bottom, both market cap adjusted and index starting with 100 over the last 3 months. How do you think this is going to normalize, if it has to, over the next 6 months or so to end the year?
Yeah, Alex, you make a great point there. This inversion, I think a lot of us didn't necessarily anticipate. So much, really since 2022, of market gains have been driven by the S&P 500. And, you know, I would say a secondary reason that I am also constructive about the second half of the year. There's a potential here for, I think, the baton to sort of get passed back to some of the Mag 7 names. The headwind, though, I see is really how they handle the earnings season that we're about to walk through. So much of the criticism, of course, has come down to their free cash flows being eaten up by all this CapEx spending. I think that they're, you know, the Googles of the world, the Microsofts of the world, the Amazons of the world are going to have to basically find an antidote to that narrative. And I think if I had to guess the way that they will come at that this earnings season is they're going to point to basically some of these balance sheet earning gains. So many of them have stakes in SpaceX and the frontier models like Anthropic and OpenAI. And so how they handle that narrative, I think, is going to basically tell me whether or not they're going to be able to pick that baton back up for the second half of the year.
Okay, and I know you mentioned sort of expectations for earnings, but say looking back a bit in the rearview mirror, what has impressed you the most about some of the corporate earnings we've gotten this year, and can you expect that strength to, of course, continue into the back half this year?
Yeah, I don't want to say that I'm certain that we're only going to see green from here, because I do think that there are some headwinds the market has to deal with, some uncertainties, you know, around even, you know, Kevin Warsh, certainly some of the AI trade cooling and things. But what I like about it, to our whole conversation here, is there is multiple ways that the market can win. You know, it could be handing the baton back off, but but it also very much could be earnings continuing to expand. I don't anticipate earnings to go down or even just break even in Q2. And so since we saw 84% of companies show earnings per share growth across the S&P 500 in Q1, and to see the way they beat, I don't anticipate that kind of beat in Q2, but I do see the breadth and the depth of the market still continuing. A lot of that has been highlighted the last several
Here it
weeks,
comes.
month and a half or so, by the RSP, the equal weighted S&P 500, basically beating the market cap version.
Yeah, talk to us. Is that where you position if you were kind of getting a little bit more granular than the headline index and starting to look at whether it's factor-based, equal weight versus cap-weighted? We talked about this as well, which is you could see some of this rotation. Certainly equity dispersion is definitely elevated, but it can normalize and you can see a rotation. And like today, the NASDAQ 100 is down 1.3% despite half the stocks in that index being higher. Is equal weight a good way to play for this rotation? Still be long equities, but not be as exposed to the AI trade maybe unraveling a bit?
Yeah, I mean, if you're an investor and you're saying, hey, I do see, the memory semi trade having gone a little further than I'm comfortable with. We could talk about whether or not we agree with that. But if that is, the perspective, I very much think that that's a nice way to diversify. We've had really our eye on that diversification method for the last several months. I do think that I don't want to be unexposed to the Mag 7 names at the valuations I'm seeing, Alex, but I do like that methodology, especially from a diversification standpoint.
Okay, so as far as looking at some of these Mag 7 names, and I mean, do you zoom out right now and include some of like the memory suppliers or these more advanced storage providers? Because that's really what's buoyed the market outside of, I mean, like we've called them now the Lag 7. I know that they're not quite there yet, but it does seem like technology has really evolved away from your like NVIDIA's, Meta's, Microsoft's into your Microns, your SanDisk, I mean, these true memory names.
Yeah, at the end of the day, like to kind of further the discussion on that side of the coin, Micron specifically obviously had this huge earnings beat. It sold off sort of before earnings were released, and then that had that huge 10% bump. If you believe their forward guidance, it's still trading at a single-digit forward earnings multiple. And so whether it is Micron or SanDisk or the others, I think that fundamentally right now, we have seen this narrative of the suppliers versus the spenders. We talked about that. But where does that mean, investors can seek opportunity? We still have, or I would say we're still early in the innings with the overall CapEx that we expect. $11 trillion between now and 2030 tells me that some of what has kept these PE ratios on, memory chip suppliers so low is because of the cyclical nature of them. And so I think if we think about whether that cycle is still the case, that is where investors will decide if they see that upside. If we think about robotics, if we think about, basically the continuation of demand for chips in a new way, I start to think that that gives a fundamental case for why, it might not be as cyclical as it was in the past.
Ted, this has been awesome. Real quick then, kind of tie it all together. You said there's still a few of those Mag 7 names, especially as they've come down, that you like. You got a couple names for our viewers that you like of that group?
Yeah, I mean, it's hard for me not to look at Microsoft and say, man, I just can't see a company of its, magnitude, credibility, led by, and a great CEO and Satya, not be an attractive name. It's trading basically near its 200-week multiple, or 200-week moving average. The valuation there I like a lot. I think presents a lot of potential opportunity for investors. Amazon is one I'm really bullish on. And honestly, I know it's been criticized lately, but I think Meta, if we fast forward, has shown a great track record and could be an opportunity as well, Alex.
Yeah, and I think there's definitely going to be some critical tests that are met when we get the next wave of these big tech earnings. I'm sure we'll see some volatility, so always keeping things exciting. But so appreciate it, Ted Thatcher, president of Bright Lake Wealth Management, for all of that breakdown. Now coming up next, last but not least, it's time for Under 30, and we are talking all things Rivian here, as we do see Rivian right now selling roughly 75 million shares to help repay the U.S. Energy Department loan, which had the shares sharply lower. So I'd now like to welcome in George Tillis, senior markets correspondent for the network, for some more insight on what's driving Rivian shares lower. Not so much at NVIDIA today, but Rivian having its worst day now in about a year and a half.
Well, yeah, so we talk about this all the time, guys. What's happening with some of these businesses or many of these businesses that are growing, and Rivian is, and I think we talked about this not too long ago, this company, in terms of how their delivery numbers are actually improving and the company's, generating more scale over time in terms of lower operating losses right now as opposed to where they were much in the past. But effectively, a couple of news catalysts that occurred were for Rivian lately, which is essentially that they upgraded their guidance for Q2 sales. And this is after last week's news associated with the delivery numbers, which are actually better than estimated, as well as an increase relative to what they expect for deliveries this year. But their Q2 revenue guidance increased from 1.55 between 1.55 and 1.65. So let's call it 1.65 billion at the midpoint versus 1.46 billion. While at the same time, this is where the caveat lies in the share price decline is they essentially announced a secondary offering. So an underwriting offering of worth about 75 million shares at the market with the option of an additional 11.3 million shares. And that's adding pressure to the stock today, down roughly, as we can see, about 15%. Close
Here we are at the 100
as a result of this secondary offering.
Yeah, George, we talked about this.
George.
Kind of a pure play.
SPX. I waited for this. 75.25s. Georgie Wargie. I'm not in it yet. I'm debating. Seems like we could go down more. Maybe hit the 200. Probably another missed opportunity here. Did Sydney trade? Yep, there it is. Dadgummit. Oh well. $60. 65. Could have maybe got 215. 220 for sure. I'm going to go right down the street for a second.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
And no cleavage.
Bell to the closing bell. We've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen,
Even
anywhere,
pennies,
free.
all the penny stocks are selling.
SchwabNetwork.com.
Mom, when my grandparents moved, our family would become.
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Boom, boom. Yep, she went up and set it down.
Intern, this place is incredible. It's where I get all your office supplies. Your golf balls, your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between. I think I'm gonna be sick. We have to buy that now. Schwab.
Invest your way with Schwab.
I'll be right back.
Welcome to the watch list. I'm Nicole Petalides. 2 p.m. Eastern time on the floor of the New York Stock Exchange. And you may hear some noise about the World Cup because there's a lot of action here, not just in stocks, but a lot of excitement for the World Cup and more. So when you hear some shouts, that may be it. In the meantime, we have a big show for you today. We had records on the Dow Jones Industrial Average. Though it's down 138 points today, in the morning, it hit an intraday record high and closed yesterday above 53,000 for the first time. Today we're going to spotlight tech and new hardware announcements from IBM. IBM rang the opening bell here today, and we have some details. I can't wait to have this conversation. New configuration addressing the ongoing data center constraints. Our panel is ready to talk about earnings when it comes to banks. Those are beginning a week from today. And we'll discuss SpaceX joining the NASDAQ 100. Our guests from Clear Street, which initiated coverage on the company today, will join us. We have a lot to discuss. In the meantime, take a quick look here at the markets. The pressure has been on as oil has moved up almost $2, up almost 2%. Right now, $70.51 the barrel. You had 2 attacks in the Strait of Hormuz reported overnight on 2 vessels that did experience some damage. Oil moved higher. The 10-year bond yield has been moving higher. It's at 4.52. The 30-year is above 5%. These are the kinds of things that could pressure this market, and we'll talk about Samsung and the weight on the chips in a moment. In the meantime, take a look at the big picture. And market breadth has turned a little more negative now. Down volume is outpacing up volume, but not by much. I mean, it could be anybody's game at this point, right? Because you do have some strength in energy, real estate, healthcare, utilities. On the downside, industrials, materials, and tech with down arrows. You know, you're seeing some of the Mag 7 names, right? Tesla, and but NVIDIA, Apple, Google, those have turned into the green. Those were red earlier today. So anything goes here on Wall Street. The VIX is at 1560. Volatility, while it's not a fearful moment on Wall Street, there is some back and forth that's happening. In the meantime, let's break it all down. We have a lot to discuss in today's show. 2 hours from the closing bell, and here's a look. Crude oil is up 2.8%. Gold pulls back 1/3 of 1%. 10-year bond yield has been running up a bit. The dollar stays strong, 100.72 in Bitcoin. We're going to talk crypto. Have you seen this recent move in Bitcoin? Right now, it's at 64,305. That's the highest we've seen in a while, in a recent while, I should say. We'll talk crypto in a bit. Joining me right now, Market Moves. Let's break it all down. Diane King Hall is with me, and as we take a look, as the market is dipping from yesterday, it's really tech and what we heard from Samsung. You know, we looked forward, and they're talking about over 1,800% jump in the operating profits, but it wasn't good enough to get everybody excited.
Which is wild, because if you ask certain other companies, they'd be happy, more than happy to have some numbers like that. But it wasn't enough, clearly, because, you know, the view is one, it was priced to perfection coming into it, and this is causing a knock-on effect that started this morning, circling from Asia here to Wall Street because of those results coming from Samsung. So you have a rout happening in the tech sector, but those would argue that it's a rotation, not a complete rout when you think about markets, because even to your point, the down to up volume in markets is not that great. And when you look at the sectors in the S&P 500, there are more in the green than are in the red. It's the heavyweights that are obviously causing some impact. So investors are pulling the plug, at least for today, on the tech sector. You got AMD under pressure today. It's still in the red. It's down by more than 5%. We're off the lows of the session, though. SanDisk getting hit hard, is down more than 8%. Micron also under pressure. Intel also under some heavy pressure today. Western Digital. So you got these memory names. Investors really, you know, what were the winners yesterday or the laggards today? There are some who are questioning, where are we in the timeline of the tech trade? So they're pulling back on chips, those high value valuation names that we've seen so much momentum around so far this year, where you could say, you notice those stocks are up, you know, between 200 to 500 or more than 500%. Whether we're talking about the SanDisk, Micron, AMD, not up as much, but more than 100%. Nobody's crying over that strength there. But again, so investors taking some chips off the table, and then there are those who are questioning what happens when things turn. So it seems like some investors are getting, I guess, potentially in front of that, because there is a supply-demand dynamic that is in favor of, for instance, the memory names right now. But we know it's a cyclical sector, and so, you know, again, I just want to point out it's a rotation, not a rout that we're watching here real time. And of course, the SOX is under pressure, which is probably no surprise when you see the weakness within the semiconductor space here, Nicole.
And I think about Samsung and the point that, you know, its outlook is 19-fold. I said 1,800% for a surge in quarterly earnings. That is what the company is projecting, folks. And that's great. I mean, you can't complain about that. But the question becomes the bigger picture about AI. And that's the fear that spread through the market a bit in Asia, and the Kospi, and then our chip stocks here at home, is the AI spending versus the AI demand, which is all, as you use the word perfection, price to perfection, and will it continue to be so? And that was one of the big questions. It just spooked the market there and here. And that's what we saw in the big picture. So, you know, and of course, SK Hynix is coming to the NASDAQ too, so we'll have that ADR, and Micron has been a big story, and a lot of the analysts think this sell-off that we've seen in Micron is just a temporary sell-off. We're going to be talking about this a lot later in the show, but would love a little preview here on SpaceX and the NASDAQ 100. Let's talk about that.
Touching down on the NASDAQ 100 today, so it's joining that benchmark today, and this is an accelerated timeline to what has been previously the case. It comes less than a month after its IPO and its inclusion in the Russell 1000. This is also the end of the quiet period, the post-IPO quiet period, and so what we're seeing now is Wall Street's first take on SpaceX. Not just share price, we've seen its first take on that in terms of how shares have performed since it debuted on the public markets. But what do analysts think about this company? The majority of firms, starting with a buy or the equivalent of a buy rating, overweight, outperform. So there's optimism about the company's potential from here. Morgan Stanley, they're in the optimistic, the bullish camp there. They argue that SpaceX combines, we know that the businesses that they're combining, their launch services, the low orbit satellite network, and emerging AI infrastructure platform. They think that that means that we're going to see growth. JP Morgan, they hone in on the AI story. They're also bullish. They focus heavily on the AI side of it versus the rockets, versus the space. They are expecting massive rapid revenue growth through 2030 here. They are assuming that Starship will become highly reusable. Bernstein says it's a huge opportunity if execution follows here. They think the biggest value creation could come from the AI and orbital data centers, but they take a more conservative view on how quickly Starship can scale. Capital spending is a key risk that you hear from all of them, even the bullish ones. And not everyone is bullish. Again, most are bullish. But you have MoffettNathanson, who has issued coverage with a neutral rating. They think it's difficult to value. Still in the early days.
Look, all right, we'll have to wait and see. Also, there's a lot of talk about the potential for a combination with Tesla. And we're going to talk about all of this. We have a special panel coming up. We have the folks from Clear Street joining us. We're going to talk tech. IBM that debuted the hardware today. We have Hyperframe with us, and also more on SpaceX with our panel later. Diane King Hall, thank you so much. Great to see you. And folks, just stand by because we have so much more to come here on the watch list. All about tech and crypto. We got you covered. We'll be right back.
You could win. You could bet on this and lose. This and lose. This and win. This and lose. This and lose. This, lose, lose, win. Lose and lose, win. Even this, lose. Betting isn't investing. Investing is owning. It often rewards patience and discipline over shots in the dark. The long run belongs to those who invest in it. Own your future. Don't bet on it.
Hey, Bob.
Hey, Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, I had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Right here on the watch list. I'm so glad you're with us. Today, IBM rang the opening bell, and IBM is in our tech spotlight. Joining me right now, Stephen Dickens, CEO, Principal Analyst at Hyperframe Research. And I'm so glad you are with us. As we watched IBM, they have some new major hardware update that they're sharing, and you're privy to know all of this. Tell us a little bit about it.
So this is the core franchise, Nicole. IBM's really been on this path for, this is 62 years now. They've been bringing the mainframe to market. 90% of the Fortune 50 run on this platform. 80% of the financial transactions go through this. We're talking JPMC, we're talking Visa, we're talking MasterCard. All of those transactions go across that platform. And what IBM announced today was new form factors, new software, and a really strong sort of update on this core franchise.
Now, IBM stock has been on an upward trend, and I know you don't talk about stock, but some of it could be attributed to the strong financial performance, and you wanted to talk a little bit about that. What is IBM doing right?
So IBM's really positioned itself as where AI happens in the enterprise. So announcements today from these guys are on a trend around transactional AI, bringing that AI right to the transaction, whether that's something like fraud scoring or being able to bring that inference workload as close to the transaction as possible. The other thing that they've been doing, they made announcements recently around innovations at the semiconductor space, getting down below 1 nanometer. They're also doing a lot from their research side. And so there's a lot going on with IBM that's very much on trend. They're not where those frontier labs are, so they're not getting buffeted by some of those huge capex and the circular economy stuff. But what they're doing is delivering consulting around AI, they're delivering core infrastructure, and they've got a solid platform.
So when we think about consolidation and automation themes, this goes right into that. Which part is more prevalent?
So they made the recent acquisition and closed that with HashiCorp, huge automation software portfolio. They're making announcements today to bring that to the mainframe in more detail. So that's really down in the guts of how automation happens. That was a big acquisition for IBM, and they're really delivering on that, and they're starting to see that build out across their install base. And then you look at the consolidation. As the supply chain becomes an issue, IBM with its in-house supply chain, they're not buffeted by some of the memory stock challenges that we've seen in other parts. Then their supply chain's different. US-based company bringing these servers to market. So as customers are looking at, can I actually get hold of this server? IBM's got a role to play.
And there's a feeling that IBM's stock momentum is really bringing some validation for what the company is doing right. Bank of America also came out yesterday and made its call and raised its price target. It has a buy rating and raised its price target from $315 now with a $330 price target. It's at $310 today. When we think about what it's doing here and the data centers and how this will address the data center constraints specifically. You talked a little bit about it, but could you expand on it?
Yeah, so I think you're pulling on the right thread there. Some of the market consensus from the equities guys is starting to reflect what I'm seeing from a technology point of view. The company's got strong infrastructure portfolio, and enterprises, they look at sovereignty of data, where that data resides, and how organizations are looking to secure that. They look at the increased transactions. They look at, can I get access to this from a supply chain? IBM's portfolio is getting really well considered as enterprises wrestle with some of those constraints. And then you look at what they're doing further up the stack with some of the software. I mentioned HashiCorp. They made the acquisition of Red Hat back in 2019. That portfolio is really starting to mature. Those enterprise workloads for AI are getting delivered in containers. So that's giving a tailwind for the Red Hat business as well.
Yeah.
So, lots to like.
Yeah. And when we talk about these configurations, I think we should use the proper names so people become maybe a little familiar with them. I see Z17, Linux 1.5 configurations that will aim to address the modern data center space and cost constraints. So that is part of it too.
For sure.
You know, we think about that because you said it's basically the counterweight of expensive public for the cloud model, right? It's sort of the opposite.
It's bringing those workloads on premise, whether that's in your data center or in a co-location, something like an Equinix. It's been able to give you sovereignty. So you've got the mainframe for those traditional transactional workloads, and then Linux One for those Linux-only workloads, things like Red Hat, being able to produce some of those more modern Kubernetes-based infrastructure. So IBM's got two horses in this race.
So the on-premises enterprise AI is real, and this seems to be working. It'll help with the cost constraints, the space constraints, and everything that goes with it.
100%.
Is there anybody else doing anything like this?
So this is in the same market as Dell. This is where HPE and where Lenovo. I've been with Dell and Lenovo and Cisco and IBM. You know, all of these guys I'd kind of put into the space. This is, as we go into the next earnings cycle, Nicole, these are what I could describe as the picks and shovels of the enterprise AI wave. We've seen Dell go on a tear recently. I think HPE, Lenovo, Cisco, and IBM are also in that cohort. So I think those are the names I'd pull out as really looking as now inference gets deployed more in the enterprise. We've gone past that initial training. We're now into inference. There's a huge way for this to run. We're still really early, and I think we're, 3 years into the AI trade? We're still the first innings for this in the enterprise.
Were you with the IBM folks today here?
Yes.
I saw you. We
Yeah.
saw you here, so I presume that. How would you describe how they were feeling here? And I mean, what is the takeaway from this? We got to go, but I just wanted to get
Really
some color
bullish.
from your conversations with them from today.
Really bullish, strong momentum. I spent some time with their SVP, Rick Lewis, and their GM, Tom McPherson. Really bullish, lots of customer momentum. I was also with their global head of sales for that business, Jose. Really strong momentum, and they're seeing that come through from clients.
Yeah, I think that's important because, you know, that's one of the advantages we have of being here on the floor here and having our Schwab network set here in Europe and having you who just had some great conversations with the SVP and the GM and some of the sales team. Thank you so much. It's great to see
Always a
you.
pleasure.
Stephen Dinkins with the inside track there. CEO, Principal Analyst, Hyperframe Research. Thank you. Coming up, we want to dive into cryptocurrency, which actually has gotten a recent pop, but the volatility may make some people uncomfortable or maybe not in that space. So should we expect that to continue? What's next for crypto? And we're talking SpaceX later. We'll be right back.
Kick off. And the decisions moving markets.
Okay, I'm back.
Morning Trade Live breaks down the macro moves driving the price action from
Not
Fed
happy.
policy to global growth.
I had, was it last week? I seen some dirt on the inside of my window. So I took my glass cleaner and I cleaned off the windows. And then this week I started noticing that there was a film on the inside of my windows, and I'm going, what the heck happened here? And I got in there and started scraping on it, and it scraping off. I said, I don't remember spilling anything on my windows. And then I got in there, I started rubbing on them, and I looked at them again. I said, God damn, now I got scratches all over my windows. And so I took it down here to the film shop. I said, what? I don't know what's going on with my windows. All of a sudden, I'm seeing velvety, this kind of stuff through them, and that the coat on the tent had wore off. I'm going, shit, one thing after another. So I drove down here and had him look at it. He's going to replace my driver and passenger tent. So I got to do that. That's where I went and had him look at it. I said, I don't know what's going on with my windows. So don't use ammonia on your glass, on your tinted windows. Do not use ammonia. Use water and a dry cloth. So I got to do that tomorrow. I swear, I just want to retire a minimalist. It was what? Last year, the year before last, we had that real cold winter. And I think I broke 3 things that were plastic outside because it got so cold. That was a year that everything I had almost owned broke on me. Everything, so much stuff broke on me. I'll go get my coffee. These QQQ's still looking good. Holding up there, and just wants to break the moving average, just squeezing. IWM's at the 63. Argentina won 3-2. All right. $626.98 for Meta. Spy trying.
From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360.
1:30.
Coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Oh, I'm ready. I'm Nicole Petalides. We are live on Wall Street. Welcome back to the watch list. Looking at the markets, 90 minutes left in the trading day. The Dow's down 110 points. Any gain on the Dow is a record close. Yesterday had its first record close above 53,000 ever. So, look, you still have an hour plus of trading, an hour and a half, 90 minutes. So let's see what happens. The S&P right now is down about 20 points. Also, we take a look here at the NASDAQ, which is down 1.3%. It's been tech that's been under the pressure that we've been talking about on the heels of Samsung, which weighed on the Kospi, which then hit our chips here at home. So that has been, you know, sold off across the board in memory and chips and SanDisk and Intel and other names, Western Dig, KLA, Lam Research, all was down arrows. All right, there you have it. We are above the lows, though, and I think that's worth noting. In the meantime, we have a preview of the big bank earnings as we start off earnings season. Really happy to have with us here today John Petrides, Portfolio Manager at Tocqueville Asset Management, and Christine Short, Head of Research at Wall Street Horizon at TMX Company. Glad to see you both. John, I'll start with you as I was looking through your notes, and obviously there's a lot of anticipation. Banks, the anti-AI trade, can we look to the banks for something different, and what are you expecting?
I think what we've seen is, you know, in the months of April and May, investors sold off everything not nailed to the ground to buy anything tech, AI, hardware driven. And, you know, that was really a momentum trade into growth and out of value and everything else. And what you've seen in the past couple of weeks is, you know, that sell-off in growth and embracing value, financials in particular. So the three things I'm looking forward to in the bank's earnings season is, one is, are the banks embracing AI from a technology standpoint to become more efficient? The second one is, what about these non-deposit financial institutions that are on the bank's balance sheet, where the bank made loans to private credit, private equity type companies? How are those holding in? And finally, what is the IPO, what is the investment banking market like, particularly for the money centers? You know, we saw obviously the big anticipation of SpaceX, but then we've heard some things like OpenAI being pushed into 2027. Is that changing the course for banking expectations for the year? So those are the three key components I'm focused on next week.
And you still like the industry, you said. Christine, you talked about investment banking returns, wealth management, trading revenues. What are your expectations for those segments within the banking industry when we hear from these banks next week?
Yeah,
that's right, Nicole. Those are really the bright spots that we're looking for ahead of the bank earnings starting on Tuesday. Overall, financials are expected to post year-over-year earnings per share growth of about 5.8%. So they're not really one of the...
Just hit my support
overall growth for the S&P 500
on SPX.
EPS is expected to be more like 23%. So they're kind of at the bottom half of the sectors if you look at them. Revenues, however, expected to be 8.8%. And so we don't often see revenues outpacing earnings per share. Why is that happening with financials or some of the banks in particular? Well, that's due to loan loss provisions. So that's going to be one of the tailwinds that I'm looking at. How much money are banks now putting aside because of, you know, consumer debt, consumer credit card debt in particular? We've seen is sort of hitting a record here. Delinquencies are hitting a record, especially those of 90 days or longer. So we're going to want to see how banks handle that. But as you pointed out, there's certainly many tailwinds to look out for. Investment banking, deal making, M&A, certainly going to help. Morgan Stanley, as well as Goldman Sachs. So yes, perhaps those AI unicorns such as OpenAI and Anthropic, we'll see where they fall in the year, if they fall in next year, but certainly the door's been kicked open on deal making, whereas it's been sort of stagnant the last couple of years. Wealth management, asset values, continue to go higher in the first half of the year. They're making up
What was that?
total assets under management. So that should help those wealth management desks. And as you said, trading volumes. We have had volatile trading throughout Q2 with the conflict in the Middle East. The
SPX hit my alert.
Energy shock. And so you're going to see that trickle through to trading revenues, specifically the fixed income, currency, and commodities desks.
Look, I mean, I saw Bank of America hit a high today. The XLF is at a high today. So you are seeing some momentum there. You did mention, so your bright spots and tailwinds that you mentioned here, what we did see, Christine, you talked about investment banking returns, wealth management, trading revenues. Now, one of the things that could be a headwind, the other side of the coin, are these non-deposit financial institution loans. You mentioned them briefly. John, but you said, how are these loans performing? That's what you want to see, because there is some fear in the market on maybe possibly some not such great news. What is the fear?
Yeah, I'll take that. For the first time in a long time, I'm actually not overly concerned about the 30, 90-day loan portfolio, the credit portfolio for consumer loans specifically that banks are making, because the underlying economy is actually doing okay. And the fact that the yield curve has been pretty steep, where particularly during the quarter, you saw 10-year yield on a 10-year treasury significantly higher than that in 2-year, which is usually a very good environment for banks to operate in. So, but the off-balance sheet, the non-deposit stuff, that's where there's concern, and that's where you saw, when we saw this sell-off in anything software related, or anything where this idea was, the investors, when it came out to Claude and Anthropic, the power that AI can do with agentic AI, it was very much a shoot first, ask questions later. And banks, the insurance industry, all got caught up in that, because investors would say, well, Claude can do it. And not even giving banks the chance to compete.
Nice reversal.
Verifying if that's true or not. So I'm really going to be curious to see how the insurance industry, specifically the bank,
right to right where I called it,
is looking to embrace the new environment, the AI environment that we're heading into.
And I think another point, thank you for that. And I think you made a great point here, Christine, about what we're expecting for as far as earnings growth. And Wall Street has been wowed, right? We're talking 7 quarters of double-digit growth for the S&P 500. And you talked about energy, tech, materials, some of these areas that have really seen some major growth, but that financials were looking more like 5.8% growth. I mean, we'll take it type of thing, but it's certainly not what we're seeing in the rest of the market. You did note some headwinds, and if you'd like to focus on one or all of these quickly, net interest margins, right, those facing pressure, rising credit provisions, and loan growth deceleration. Would you like to touch on the headwinds here?
Income margins, we haven't quite talked about. That's sort of a double-edged sword for the banks, right? Because the Fed has kept interest rates at that 3.5% to 3.75% range. And because of that, customers and consumers are still looking to keep their cash out of low-yielding products, and they're in search of things like high-yielding savings accounts or money market alternatives. And so the banks are losing out to those customers because they can't necessarily offer
always clean as Jim.
6% rate on that cash.
Hello?
It continues to baffle me. We did get lower than expected jobs numbers last week, and that's sort of the final shoe to drop. The consumer tends to go the way that the jobs numbers go. And if they don't feel confident that they're going to be able to keep their job or get a new job if they were to lose theirs in the next 6 to 12 months, then they're not going to be as willing to spend. And I also look at the bifurcation of the consumer, this K-shaped economy we're always talking about. Really, the consumer continues to be dragged along by that higher income cohort. So on the lower end, you still have folks struggling to buy necessities. And I'm just interested to see, like, Jamie Dimon and Jane Fraser, what their take on the U.S. consumer is and some of this consumer debt that we're seeing.
All right, well, Christine Short and also John Petrides, great to see you both. And Tuesday, we really kick it off. We'll have Citi, Goldman Sachs, JP Morgan, Bank of America, and Wells Fargo. We'll all be watching, and then we'll circle back and see what of our conversation really comes to fruition. And we'll have another conversation in the future. Thank you both. Good to see you both. Thanks. Kevin Hanks is joining me live at the CBOE as we look at some of the stories here, and I will say I see energy and real estate really doing well, industrials and tech under pressure, but it looks like we come up off the lows on the Dow. What are you seeing there?
Yeah, here we go again. It's 140.
And the S&P 500.
SPX is back down at support. Really hasn't failed yet today. One slip down to the 200 would be a nice catch. These are 75.25s at 75.20s at 290. 85.
You've got the dollar higher, you've got yields higher, you've got crude oil higher. So the macro is working against this market, but right now it's still 7 segments higher and 4 lower, Nicole.
Yeah, and you know what did catch my eye? Caterpillar, GE Vernova, some of those names are under some pressure when we think about industrials, but there's definitely, I've seen some stories about that they have room to go. But today, we are seeing those names under pressure. Anything else you'd like to add?
Industrial sector down about just under 2% on the day. So that's one of the S&P 500 sectors that is certainly struggling. So watching that, Boeing was higher early morning. Now it's on the downside as well. So yeah, industrial's having a rough day here today.
And here it comes down. Now I'm ready.
So we're seeing a lot of those with the down.
Patience, man. I'll tell you what, it's been really paying off here lately. In this kind of market, I would have jumped in that double bottom off the 200, but I waited for this one. Oh, take a little snap at it. We're almost at the VWAP over here on the /ES, so I'm going to get in this thing. Nobody can stop me. $75.20s at 220. About now. 220, 205. $215 and $220. These are 75 20s. Lotto, 215 and 220. $200 SMA. my $2.55. $2.70. Got an ascending triangle off the 200. Damn. $2.85. $2.90. Another fat knife. Damn.
cash flow going forward. I'm curious to see what you found. Did you find somebody supporting the upside or the downside?
Yeah, probably supporting the upside, but taking advantage of the pullback that we're seeing here today. We've seen that rotation trade kind of ping pong back and forth between people piling into these chip names and then piling out of them on a day-by-day basis. So you got to take that into context. You mentioned the stock's still up about 225% so far in 2026. So it's had a good run. Samsung earnings weighing on this sector today as that stock pulled back 7% overseas, and the Kospi South Korean index pulled back over 5%. So getting some weakness here today. You did mention Citigroup added it to his 90-day positive catalyst watch just yesterday. But we're seeing some people probably taking advantage of this pullback, using the option market as leverage, creating a big, massive gap to the downside before they start getting hurt. We saw a trader sell some cash secured puts. A trader sold 15,000 of the July 17th monthly options that expire in a week and a half. The 690 strike puts far out of the money to the downside, but they collected a credit of $6.30 per contract they sold. So that takes a break even where this trader starts to lose money all the way below $683.70 to the downside over the next 10 days. That's 26% below the current share price. So 10-day trade, this trader thinks, hey, I'm going to take advantage of the higher implied volatility because stock's falling and the pullback. Remember, this stock's in bear market territory. It's 26% off of those all-time highs that we hit just 2 weeks ago. So taking advantage of this pullback today, selling some out of the money, deep out of the money puts here in Micron with the expectation it's not going to go down much more, but they got a big 26% cushion.
All right, last but not least, I don't want to let you go. I want to talk about Disney, which has been coming under pressure. What did you find in the session here? Because Disney is down about 15% or so this year, while everything else has had an incredible first half. Right?
Disney sucks.
At least. What are we looking at for Disney? What kind of trades did you find?
Yeah, a lot of these entertainment stocks have pulled back pretty significantly, haven't participated in the rally that we've seen in the overall market. And now you've got...
Disney used to be a good stock to trade. But once they went woke, it's been a horrible stock. And then you got all these fights breaking out on the ships. On the cruise ships.
August 100 strike calls and sold 10,000 of the 110 strike calls, so a $10 wide bullish call vertical. They paid an average debit of about $2.76 for this call vertical, so the risk reward's pretty good on this setup. The break even where this trader starts to profit is 102.76 over the next 45 days, so they got plenty of duration in this one. That break even's about 6% above the current share price in Disney, with call volume about double normal daily average volume that we've seen over the last 5 trading days. So instead of just buying the calls outright, they did a call vertical. Limits your upside, but it's a pretty good risk reward setup, paying only $2.76, and this thing can expand to $10 if it gets above $110 over the next month and a half.
All right, real options trades there. Tom White, thank you. Disney and Micron and more, thank you. Good to see you, Tom. Thank you. All right, folks, I'm so glad you're with us. Thanks for joining us here on the Watch List. I'm Nicole Petalides, every day at 9 a.m. and 2 p.m. here on Schwab Network. You can get the Schwab Network app. You can download it. It's available in the Apple App Store for free. You can tune in 24/7 on schwabnetwork.com and watch there. Easy peasy. Market on Close is next.
They're checking. The checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world.
Good. This commercial's over 6 months old. More drama. Damn.
Our Chicago headquarters.
And I'm Sam Bartis, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what's coming up on today's show. We will discuss how chaotic and conflicting headlines are leading to cognitive dissonance in this market. Then we'll examine the long-term outlook for the market and potential timing and extent of the next major pullback. And we'll close out the show with a temperature check on the Mag 7 and examine which names in the group are best executing in AI. But for now, Marley, walk us through what you've been watching today.
Should I give it another shot?
Sam, we're seeing a slew of bullish sell-side coverage today. It's first day in the NASDAQ 100. The company has at least now 30 buy ratings, one neutral that I saw and one sell, with the price targets ranging from $800 all the way down to $131. Amazon also on my radar as it reportedly plans to raise at least $25 billion through a bond sale. The 8-part bond sale will be the last debt issuance of the year, as the company already raised roughly $54 billion in bonds earlier this year in the U.S. and Europe, followed by a $10 billion bond raise in Canada to fund its massive AI investments. And Cloudflare getting a significant boost as Scotiabank upgrades the stock to outperform with a price target of $300. The firm says the company's Workers platform is increasingly favored for AI applications, which may lead to better than expected revenue growth in the second half of 2026. We've got a lot to get there and several more top movers to talk about. But first, let's check in where the markets stand as we near the end of this trading day. We're holding on to the red that we've had all throughout the day. The S&P down 0.5%. We're at 74.9893. On the NASDAQ, we're at 29,140. That's down almost 1.9% on the session. The Dow is down about 1/3%, 52,877.51 after closing above 53,000 for the first time ever yesterday. And the Russell 2K is down almost 0.9% at 2983.68. Taking a look at some of our futures products here, the 10-year continuing to tick higher. We're at 448. The dollar also slightly higher.
$2.90.
Gold is at 41.31.10 a troy ounce. Crude oil now above $71 a barrel. We're at 71.55.
Now you got to hold.
Bitcoin staying in range. We're at 63,925. I do want to send it back over to Sam, though, to find out what's been sticking out to her on the session.
Hold.
Yeah, this momentum unwind, Molly, a difference a day makes. The SOX has been trading below the 50-day. We're seeing a negative reaction to great earnings estimates from Samsung. Expected profit up 1,800%. Some saying this is a sell the news event, given the run-up that we've seen in memory names. So the commentary is more around the positioning rather than the fundamentals for the company itself. Not helping sentiment today in this chip trade is the report that DeepSeek is looking to develop its own chips to reduce reliance
I'm getting back in it.
Huawei as well. So we're seeing a big rotation day out of chips into places like software, Mag 7, the rest of the market. Breadth this morning was positive, a 3-to-1 advance decline. So it really is largely a chip-led sell-off, as well as industrials and materials, which have been trading as these sort of AI-adjacent sectors, the so-called AI food chain. But the rest of the market has been holding up okay, like energy, utilities, consumer staples. Of course, Walmart says they're going to cut some grocery prices, so perhaps that's feeding into part of the defensive trade today, particularly on staples. But Molly, I'll send things back over to you and Jenny Horn in Chicago with some of today's top movers.
Well, thanks so much, Sam. Like you mentioned, Jenny Horn joining me here in our Chicago headquarters to take a look at some of these stocks that are on the move today. Jenny, we have to start talking about SpaceX. I mean, still trading down quite a bit on the session after getting what can only be described as the day went on, just an absolute flurry of buy or buy equivalent ratings. Yes,
That's already up $100. No, I did get in it. Never mind, I got in it. Jimmy is in them. No.
Require shares to basically quintuple from these current levels, and they said that just like railroads, electric grids, and the internet, they believe SpaceX is building the foundational platform for the next generation of industrial capacity. Not everyone was quite as bullish, but it's hard. I mean, I have searched all day long to find the more neutral, if not pessimistic take to keep things balanced. MoffettNathanson is one with a neutral rating. Well, we did also see Morningstar was one that gave a sell rating, or their equivalent to a sell rating. But, I mean, 131 is MoffettNathanson's target, so they did cite the complexity of the company. It wasn't necessarily a lack of growth. It was just the nature in which they right now are expected to grow is complicated.
Yeah.
I'm down 40 on this 30. Ugh. God. No. Well, that one got me. So far. 210, 290 and 210. Fudge. This one, I don't think I think my balls were a little too big on this one. This ain't heavy.
The longer term investment play is still sound here. The fundamentals are strong, but we saw sort of buy the rumor, sell the news reaction to this, and that is very important if you're day trading or swing trading or any of those kinds of things, but important distinction to be made there. So very good on that one. But I want to flip to Cloudflare here. We're having a really impressive session. They're up more than 8%. Scotiabank upgrading them to sector outperform from sector perform.
Yeah, and this name, I mean, is still actually slightly 3.1% off of its highs, but I mean, we're getting close today as we're up 8.3% on the session, now adding to its near 36% gain this year. And it's up about 11% just in the last 2 trading sessions alone. And so this was hugely on optimism, as you mentioned, from Scotiabank did upgrade shares to sector outperform, from sector perform, while also raising their price target to $300 a share from $225. But it's interesting to see right now this broader like NASDAQ 100 route we're seeing throughout the market. And this name has not even, paid attention to some of the broadness we're seeing in that selling pressure today. Software stocks have seen more so than recently divergence in performance. Like we've seen names that have outperformed some of these like application specific names, but there's still definitely does seem like there's room for love from the sell side on a name like Cloudflare. Not a massive outperformer, and you can see from this recent chart, I mean, it's choppy. It looks like an EKG going to the upside at least, and it's still trending in an upward channel here. But I mean, it is a name that trades with volatility, as you can see from those massive spikes and then pullbacks in the last 6 months or so.
Yeah, I mean, and there's so much to take in this note here.
A lot of weakness in the close.
The best AI native customers, they say. It validates their architecture, provides long runway growth. I mean, you can see why the reaction is to the upside on this note versus some of the other notes we've seen come out this week that got more tepid reactions. But Cloudflare having a really nice session, up 8.5%. This last one sort of sending ripples through not just the Amazon shares, but through the broader secondary markets here. Amazon reportedly set to raise at least another $25 billion.
Yes, just a cool $25 billion as they are tapping the bond market now to raise more money, while investor demand for corporate debt does remain still relatively high. And so a filing by Amazon that was issued earlier today does show the company plans to sell debt across 8 tranches, 1 floating rate tranche, which does pay an interest rate that resets quarterly, and 7 fixed rate tranches. The debt is worth $25 billion, as you mentioned, and that was per source, or that was according to Barron's. But the latest preliminary sale notice follows Amazon's sale of about $10 billion.
Amen. Amen, amen, amen. Oh no. Come on, Lord, help me with this one. It's Jim, I don't believe in gambling. Golly. Well, I don't think I got a chance in this one anymore. 30. Golly. That's it. Well, this one's got me. Come on. this. So the ammonia, the glass cleaner, is not a good thing for those tin cans. And I didn't know that. I use ammonia glass cleaner. So I'd like to go out and look at that the next day. The little medical particles in that tent, little metal. That's what the guy told me. So after they get wore out, that top coat comes off, and then, you know, they just get old and you gotta replace it. They have about 7 years lifetime on them. So shit. So I'm taking it in tomorrow, and they're gonna put new tent on the driver and passenger side. And I thought it was gonna be a lot more. It's gonna cost probably $400 to do it. Just for that. So that annoyed me. So that's what I wanted to say. I'm taking it in at 3, get it looked at. Are you gonna win? Do you think you're gonna win? You're not gonna win? Too much competition, or? Oh, no, that helps. It'd be nice if you didn't have to have money to win. Yep. Okay, well, you get your deal done, tell me if you got it fixed or not, your legalization. I just paid my auto insurance today. Blotch. So I'll catch it. It's $800 for 6 months. Yeah. What's yours? Are you there? It's about 130 a month. Less. For 50? Fuck. Full coverage? No, okay. Well, still, that's good. Okay, well. Happy birthday. I was the first, well, I know, I messaged you. I set my alarm so I could message you at 12. I went out of my way for you. Yep, okay. Bye-bye. Okay, I'll call him. You know how old he is? How old is he? 39? 39 or 38? 39. Okay. Bye. Okay, bye.
Last week can be viewed both ways. Oh, we've overbuilt, and that's why they're looking to lease excess capacity. But also be like,
let's go, baby.
We are, as in terms of Meta, able to borrow money for 30 years at 6.5%.
We're $2,
which is cheaper than most of our competitors.
Coming back.
Maybe we just become a really good service provider because this is an asset heavy, which means cost of capital is very important, and maybe they're doing a little bit of that transition. Almost think like
maybe
a
right
telecom
here.
Company. You borrow a lot of money for a long period of time, you build out the infrastructure, and then you license out that infrastructure over that 30-year period, obviously thinking you're going to collect a spread, the amount of money you're receiving versus those interest payments. So I think last week was interesting to see a little bit of that transition, but ultimately I think for this infrastructure build up to continue, it's all about the debt markets. Do they remain open to more capital coming in to facilitate that build out? And thus far, we've kind of seen no issues. The IG credit markets are happily taking down all this paper.
Yeah, I mean, and you pose a great question. When does the buck stop?
They just can't get over this CapEx thing. They've been on this CapEx thing for over 2 years. And they're still talking about it every single frickin' day. That's what their motivation on this market pulling back. And it hasn't done it. It's like the lead conversation. Please, market, pull back so we can buy the dip and run it back up. I have a way of remembering the narrative that they're always pushing. Today they said, what was it today? It's back to the CapEx thing. I can't remember.
80th percentile over the last 5 years and 100th percentile for semiconductors over the last 5 years. So the risk in terms of where the options market is expecting more movement has become very concentrated in the winners of Q2, and the rest of the folks have pretty low implied volatility. So it's a rotation both in terms of any given day, who's winning and losing from directional movements, but prices of options, the implied volatility is showing a dramatically different expectation of movement between, again, the previous winners in Q2 and everybody else.
And I know that you spend a lot of time looking at implied volatility, realized volatility, and focusing on that area. How are you looking at that then as we come into a new earnings season, and how might someone watching approach that and play volatility here?
Yeah, so, I think obviously Samsung, we'll call it as the kickoff for this next, Q2 set of earnings. Q1 earnings, in general, companies were kind of doing a standard plus beat and raise in terms of reporting, and the market rewarded those companies pretty handily in terms of movement of their stock price on the day after. Valuations are a little different today than they were 3 months ago. So I think what we saw from Samsung is what you should actually expect for earnings season when it kicks off here, that you really have to Micron level of 2 weeks ago, blow out earnings to get a positive price action on those.
No cleavage.
Anything that, if it's, margins are a little lighter in forecast, if it's just one little thing you can net at, I think you're going to have pretty big and potentially negative reactions. So I think earnings season is going to have a lot of idiosyncratic risk, a lot of movement of those single names. We'll see if it waterfalls into the market more broadly, but I think it's a very interesting earnings season considering where we are in valuations.
And interesting because they've given up all of their gains from that stellar earnings report, so in the wake of today, even with Samsung down now 7% more. Really appreciate you being with us. It's always a pleasure to talk to you, said Francis, the CIO and co-founder of Convexitas. And I'll send it back to Sam in New York with a look at what we have coming up next.
Thanks, Molly. Well, we're going to discuss the outlook for the market moving forward and the potential timing and extent of the next major pullback. That's coming up next on Market on Close.
Snake breakout pullback, inverse head and shoulders into close. It's right now 3:30. I can't wait to take this trade. I cannot wait to take this trade. 7,500 strike. Inverse head and shoulders. $2.50.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs.
Yeah,
plus a wide variety
250 to 340.
All with 24-hour support from trading specialists.
250 to
who understand
340.
the ins and outs of 24-hour trading.
250 to 370. Woo! 250 to 360. Da 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 da. What is that?
After several tankers have been attacked in the Strait of Hormuz, this has sent crude back up above the $70.
Oh, tankers have been attacked in the Hormuz.
More than 5% right now for U.S. crude. Brent is up 5
Blowing motherfuckers out of the world.
The U.S. officials saying that the MOU in effect with Iran was entirely performance-based, and because of the actions of late, they're now revoking the license allowed to produce, deliver, and sell Iranian oil. That will be in place through August 21st, this revoking of the license there. So some breaking news out of the Middle East here, sending oil prices higher. We'll, of course, continue to keep an eye on oil prices throughout the show. But I do want to bring...
Well, why didn't y'all come up with that earlier?
Turn our attention to the outlook for the markets overall. With
Instead of talking about shit.
Chief Investment Officer at Heritage Capital. Paul, great to have you on the show again. You are bullish on stocks.
God, the narrative on Schwab has changed since I started watching them. We talk about a lot of nonsense now.
Yes, geopolitics aside, of course, was going to be in Q3. And there's a number of reasons, not limited to. So number one, the kind of seasonality everyone knows about. It's a midterm election year, although it is a second-term president. Midterm election years typically see a soft patch in the middle of the year. This year it's not different. We got sentiment a little overdone in May and June. It was hard pressed to find a lot of people who were overtly bearish unless they were a perma bear anyway. But you had option traders, you had the sentiment surveys, you had a number of people who were just ignoring the downside. And then, look, we had those melt-ups. And when you're riding the horse of a Micron, of a SanDisk, of a Western Dig, and you're going up, parabolic moves rarely end by going sideways. They normally end poorly. For those who come in late, you get punished. So I think there's enough ingredients. Look, I think the bull market's old, but it's still reasonably healthy and it's going to live on to 2027. Our work, our quantitative model says the opportunity, the window's opening, if you will, for a tradable decline that we will buy very aggressively the closer it gets to 10%.
So, Paul, if the market is due for a bit of a recoil, I'm just wondering then if you believe it's a buying opportunity to take us to new highs, say in Q4, because as you point out, I mean, these rallies aren't linear, and a lot of those bullish calls on the year-end targets for the S&P of 8,000, 8,100, etc., have also said that where would the biggest opportunities be, do you think, given that we are going into a second half of the year where we do have a midterm election? And we've also seen that the market can prove that the 493 can get us to all-time highs without the participation of the Mag 7.
There's a lot there to unpack, but let me say this. So one, we're absolutely not buying more AI or AI-related instruments right now. I've said this to clients for the last couple of weeks. I'm totally okay if stuff that I was looking at takes off and goes to the moon without us. I'm totally fine with that. We've been harvesting acorns for the past couple of weeks.
280, baby.
To continue to
I'm
do
winning.
so. Unless those really high charged momentum stocks pull back significantly, and I don't mean 5%, they've got to get significantly into the double-digit territory. I'm not going to play them. And again, I'm okay with that. Last couple of weeks to a month or so, we bought some really boring, ugly, stodgy, food and staple stocks. And people, nobody wants them, right? They pay dividends in excess of 4%, but they're not sexy and exciting. So I've added those in the portfolio where I've
Called to Head and Shoulders, boom. Now it's coming back to the right side.
The question is, what are we going to buy?
So here we're going to go back up again.
they've been outperforming lately, boring, stodgy, low volatility, and that's been our theme. I've raised some cash, but I've really de-risked a bunch of portfolios to take our volatility and our downside lower because I'm concerned about the high flyers and what may unfold in Q3. So when we chat over the summer, I'll have a better idea of what I'm really.
The high flyers.
Paul, I'm talking about REITs. I had a whole conversation about REITs last week, but the guests there are making a similar point to you, saying they're not sort of viewed as sexy right now, but they should be, and saw a lot of upside there as well. But I want to dive back into you saying you're taking some risk off, you're not adding to positions in any of these AI-related positions. Why is that? Is this a valuation call? Are you becoming less confident in the AI story, or is simply just a wait and see how this all shakes out?
So again, there's a lot there. It's definitely not a full risk-off call. We're going to have a fair amount of risk on the table, but it's not going to be the risk we've had over the last couple of months. Again, I'm okay with that. If the market races ahead without me, and next time we talk, I look like a clown, I'm okay with that. But given all the pieces that I see developing, I'm not okay with leaving so much high flying, so much, beta, if you will, higher volatility, higher risk instruments on the table. Regarding, the replay, which we just talked about, our view has been all year, the next Fed move is going to be a cut. Full stop. It's going to be a cut. I think the masses are absolutely dead wrong. You already saw it in that one very volatile jobs number, but I do see the economy weakening, not weak, but weakening second half of the year. I think there's going to be a big pivot sometime in the fourth quarter, first quarter next year, and that's going to lead to another rally in back to new highs and beyond that. But I do think the Fed's cutting rates, if not late this year, then in Q1 of next year. If that's the case, then what do you look at? Well, REITs, utilities, and staples will become more in vogue. It's not a value. To me, valuation is great to talk about. It's the worst timing tool in the market. You can't trade a portfolio based on valuation because things can stay crazy high value.
Never have.
Quarters and years like we saw in the late 90s. And there's a value trap when things get cheap. They can stay cheap and get cheaper for years as well. So I don't.
Fundamental traders are having a hard time right now. I feel like Samsung had them excellent earnings. I mean, excellent. Ninefold.
An upgrade for the tech giant. That's next on Market on Close.
Hey!
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Have you ever watched an interview and thought, I wish they had 5 more minutes, or I want to know how they discovered that hidden gem? That's exactly where Market Matters comes in. I'm Marley Caden, and our podcast is slowing things down. We're going beyond the earnings to get to the heart of the people and companies driving the global economy. If you want the full story, not just the headlines, Market Matters is for you. Subscribe wherever you get your podcasts.
Hey, Bob. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable. Wait, I had a stroke? Yes. We are together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I programmed Madden 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. all crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time.
Welcome back to Market on Close. Meta is higher today after Erste Group upgraded shares to buy from hold. The firm says its revenue growth and operating margin are higher than those of its competitors, while its PE ratio is slightly below the sector average. Meta also announced today that it will debut
Yes, may I help you?
image generation model in the coming.
This call is being recorded. May I help you?
The year, but having a nice pop today on the news of that Muse AI image generator and also with this upgrade here. So, take us through what you're seeing here.
Sure, Marley, and I'll tell you what, let's start with what's going on with the S&P 500 versus the communication services sector, because I think that tells a little bit of a tale here and gives us some context. The sector itself has been performing strongly relative to the S&P 500. The sector ETF here, XLC, is the blue line. The candles are the S&P 500. Now, last week you and I looked at a couple of times XLK, the technology sector. This is a little bit different. This contains Meta and Google and others in that space, some of those hyperscalers. And it's been on a pretty strong tear to the upside here in the last 2 or 3 weeks. This particular sector tends to be a little bit more volatile in its performance relative to the S&P 500, although it does stay at a slightly higher correlation to the market as a whole. So that would suggest that the names within this sector, while a little more volatile in nature, tend to be the bigger drivers, if you will, of the market as a whole than some of those names in the technology, the pure technology, information technology sector. So this is giving us really kind of that upward movement, a lot of the contribution to that upward lift in the S&P 500 in the last couple of days, Marley.
Yeah, and so as we look at how Meta is performing against some of its more direct competitors, I mean, how is it stacking up? Because, as we know, these Mag 7 names have been pretty much called the Lag 7 for a lot of the year. And so I'd love to see its performance sort of stacked up against its peers.
Well, Lag 7 is probably an appropriate moniker here, given the fact that Meta itself has been lagging most of the other competitors within this space until the last couple of days, and this upgrade helping to fuel that flame a little bit here. You can see Meta in the green line there, starting to see a much steeper upward trend here with a little bit of a pullback. And that being the case, stacking it up against the other hyperscalers, Amazon and Google Alphabet leading in the charge here. Google kind of rolling off the top here. Amazon maybe flattening out just a little bit, but maybe a little bit of moderate performance. And you can see that all three are leading the communication services sector here in that ETF. Meta may be coming from behind to perhaps take over the lead here. It's not quite there yet, however, Marley.
All right, so as we look at the standalone technicals for Meta, what are you seeing in the setup there? Because you did just sort of set it up as our underdog here in this race. So is there the potential for a breakout here for Meta?
Yes.
It certainly looks like it from a technical perspective.
It's consolidated long enough.
Perhaps collecting itself over a while, a couple of earnings.
He just said it. He is collecting itself for a bit. It's consolidated for quite a while now. Meta. And he, right after I said that, he said it.
In this space, Microsoft namely. But you start to see that momentum pick up in the RSI. That momentum is very near to a breakout point. You get a break back up into that channel above that 584 support level. And now today, breaking back up and theoretically, although the day is not quite done yet, theoretically closing above that 50-period moving average, implies volatility relatively high going into the earnings.
It definitely was a better buy when I called it out down here at the bottom. Now we're up here at a 20-day resistance of a triple top. So it does have to have another catalyst. Maybe just the market momentum could turn it around. Tomorrow's Friday. Hmm. $165, $190. Did hit my resistance.
Markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com. Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Boom, 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 boom.
Enter. This place is incredible. It's where I get all
Got a snake breakout pullback, inverse head and shoulders.
Your fancy coffee, your giant TV. It's everything in
And I'll
one
be right
place.
back.
It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between. I think I'm gonna be sick. We have to buy that now. Schwab.
Invest your way with Schwab.
Welcome back to Market on Close. I'm Sam Bardas on the floor of the New York Stock Exchange. It's time now for Overlook Stocks. Food distribution company Chef's Warehouse rising to a new record high today. So joining me to discuss this is George Siller, Senior Markets Correspondent. Big jump for this name. Just walk us through the news here.
Well, I mean, I was just looking at this chart. It almost looks like a tech stock, and this is, again, a great example of how you don't have to be a tech stock. You could be a standard, in this case, Chef Warehouse is a leading specialty food distributor, and your stock can do very well. There's various reasons why I'll explain in a sec, but they have about 44 distribution centers. They sell essentially over about 90,000 products, and effectively they cater to independent chefs and, of course, fine dining establishments, hotels, and specialty food stores. So all of those speak towards the higher, more resilient consumer. And I think that's one of the aspects of why the stock has performed quite well relative to some of the other peers in the food distribution space. Mainstay big peers include Cisco as well as U.S. Foods. They also have e-commerce and specialty brands, so you can get some of their foods through their flagship Allen Brothers namesake brand, which is e-commerce. But nonetheless, today there was an announcement from Cowen. They actually initiated coverage to a street high on Chef Warehouse to $110, and they actually see the high end of 2026 to come in line, as well as potentially an increase from 2027 to 2028 based on higher growth and improving operating leverage for the entire business. Because if you look at Chef Warehouse, and this is why I think the stock has outperformed some of those other names I mentioned, like Cisco, for instance, it's not the scale of the business in terms of the size of revenue. In fact, their sales last year as a business for Chef was about 4.3 billion. If you look at Cisco, it was around 85 billion, so it's a much larger company. The latter is, but nonetheless, the revenue base is increasing by about 10%, at least on a trailing basis for Chef, and that's bested those other two competitors, which are around 3.5%. So it's growing faster as a business. I think the specialty foods demand is high for various reasons, mostly probably because of income disparities right now, and they cater towards higher income, more resilient consumers, and this is essentially what Callan mentioned in their call today.
Yeah, Wagyu beef, specialty chocolates. I mean, it sort of feels like a bit inflationary proof when, you know, these are sort of higher margin products as well. And as you say, catering to the top end of the K. I mean, how much of this is a trend that you're noticing in the market? Because, you know, I was having a conversation with a guest earlier today who said, look, I'm rotating into airlines because they're catering to the front of the plane. There seems to be sort of a theme playing out right now, George, where within this rotation, it is very much geared towards more of the high-income earner right now. I'm just wondering if, you know, this is being seen as sort of a beneficiary within all of that.
Well, yeah, of course. I think we spend so much time talking about technology just because of the, you know, market caps and the movements we've seen in this whole, you know, investment demand for data centers and AI. But, you know, essentially, if you look at what's happening from an income level, but that's from a corporate investment standpoint. But if you look at income levels, there's the disparity is just getting wider. And interest rates also aren't helping the lower income consumer. And essentially, food as a percentage of income affects lower income consumers more than higher income consumers. So they're trading up. They can afford to. These are higher income folks. And if you look at what airlines are doing, for example, premium pricing, they've got pricing power. There's less competition. And effectively, the number of routes and availability of tickets is lower. And so they're making a lot of money. They're generating a lot more operating profit per revenue generated. And I think that's the case here for Chef as well. The net income margin of the business is quite low, in fact, on Chef. Just to give you some example, revenue last year, $4.3 billion, but they only earned net after all expenses, $80 million. So that's around 1.4%, just roughly speaking, of net income to sales. But anytime there's an increase in top line sales, it has a trickle-down impact in operating leverage, and that can gear the stock quite a bit to the upside in a nice trend fashion, which that's what we're seeing here in Chef. So in other words, they weren't as profitable as, let's say, a Cisco food company or distributor, not nearly the number of the amount of sales, but the profitability profile is improving faster, and that's why you're seeing the stock price performance of this name accelerate faster.
Yeah, and I see as far as sentiment is concerned, I mean, Alice also liked the fact that it's been pretty successful with its acquisition strategy too, its ability to sort of expand into broader markets and internationally too. So really interesting company. Thanks so much for getting us across the details today, George. Trading high by 3% right now, $97 and change. Marley, I'll send things back over to you.
Thanks so much to Sam and George for that one. We are nearing the end of our market session. Alex Coffey will be joining us to take a look at today's action. That's all next on Market on Close. Don't go anywhere.
Market on Close. Oh my God.
Real data-driven analysis from U.S.
I think I'll go out and clean my car more often. Oh my God. 570. 570. I don't mess around. Well, I don't mess around when I buy the dip. It's called a snake. Breakout. Pullback was my last word to you all. so easy to recognize. And I think if you just wait and opened up your eyes, you might get a big surprise. Well, at home we got our problems. My tent in my car's falling apart. Don't take ammonia and clean them tinted windows. So I stepped outside with a little bit of lost pride. Came back to win. It's called a snake. Break out, pull back and boom. Snake, break out, pull back and boom. Well, we just hit the 200 EMA, and I sold the stock at a pop. I told the lady at the office, I got a crush on you, baby. Will you meet me here at 5? And I'll take you to the closest dive. We'll have a beer and get ourselves in gear. It's called a snake, break out and boom. If you got the time, I got the room. Woo! Snake, break out, pull back, inverse head and shoulders, called it. Right shoulder hit twice, high or low, boom. Well, I sit here and lost all my hair. That woman, she didn't really care. I made sure she had a roof over her head. It just wasn't enough. And then she started hanging out with a neighbor who was buff. I caught him in my bedroom. I think I'm gonna visit the jail real soon. Or should I just let her have him? I'll have more room. I knew a girl, and it really shocked me. Beautiful chick. She had twins, and she had another kid to this guy. I mean, beautiful. And during COVID, he left her. And I didn't see this girl for like 4 years. And I think during the roughest times, no matter thick or thin, something like COVID, or it's not the time to be fighting with your woman. It's time to pull together. It just shocked me. So I was talking to her about something. About her and her husband. And I was asking her questions about COVID. Oh, I divorced him. I said, what? You divorced him? And I thought that marriage was like one of the marriages that would last forever. I mean, if I had kids, twins, and a good-looking wife, I'd do everything in my life to try to keep it together. Some people just don't know how lucky they are. Treat her well, she'll treat you back. Make sure she's laying next to you in the sack. Little roof for her head on a wallflower bed. Alrighty. Well, like I said, some people don't know how lucky you got it. So we'll catch y'all later. And again, thank you